Start, sir.
Very good morning, and we are entering the second day of the National Conference on International Taxation, started yesterday, and today is the second day, and we are starting with the third technical session on NRI Taxation, new residency provisions, return filing obligation, disclosure of overseas assets, issues and cautions. This is the topic to be dealt with by CA Kumar Tejwani sir from New Delhi. Very happy to have you, sir. A warm welcome to you for this webinar, and thank you for accepting our request for a speaker to be here. And a very warm welcome to our my professional as a regional council colleague and the treasurer of SIRC, Revati madam, and also all the delegates. Thank you very much for registering for this program despite this tax audit pandemic. I will not take much of your time because international taxation is a matter of what's called a great importance in the present arena, because the professional opportunities are widening across the globe. There is no geographical boundaries wherein we can provide our professional services. Under these circumstances, Institute has taken a great initiative to conduct this program, and this program is being conducted under the aegis of the ICAI, the Committee on International Taxation, and we at SIRC are the hosts, and I am secretary in the absence of chairman, Mr. K. Jalapati. I am welcoming you as secretary of the SIRC, and before the topic is taken on by the speaker, I request Madam Revati to introduce the speaker to the audience. Thank you.
Thank you very much, Panaraj sir. A very warm welcome to CA Kumar. A very happy new year to all the members who are out there, who in spite of their busy schedules have logged in at 10 a.m. I see numbers are just increasing. I think it's currently at 279 members who have logged in, and this shows the importance of the international taxation, the impact that it is having on our practices on a day-to-day life, with the blurring of the international boundaries and the volume of cross-border transactions. This is something which, you know, every firm is going to have as a separate vertical. Every firm, even if you don't have a separate vertical, every chartered accountant needs to know about the provisions of international taxation, and this national conference is a very welcome move in that direction. So I have the pleasure of introducing our speaker of the day, CA Kumar Tejwani, and his qualifications are so enviable. He's a BCom honors, an FCA, an LLB, and a DIIT. LLB, I think, is one qualification which, as chartered accountants, we all need to actually equip ourselves with nowadays, because of the litigations also which are coming up. He's from Delhi, and he's the founder and currently designated partner of Messrs. Kumar Tejwani and Co. LLP, Chartered Accountants, which was established in the year 1995 with the head office in New Delhi and branch office in Mumbai. He qualified as a chartered accountant in 1990, a law graduate, and a qualified ICAI diploma in international taxation. He also holds ICAI certificates in indirect taxations and is also a valuer, having completed the RVO valuation course from ICAI. He specializes in direct tax matters. He provides advisory on direct tax matters, including international tax, FEMA, and assurance services. And he also represents in tax matters before the CIT appeals and the ITAT. He is a key speaker on matters of international taxation, union budgets, DTAA, and IBBI valuation courses at various platforms of ICAI in the country and abroad. And he's associated with corporates and leading professional foundations for delivering on topics of direct taxes, international tax, union budgets, and financial statements, and FEMA. He's held the chairmanship of DTC and FEMA committees of NIRC of ICAI, and he has a long association as a faculty with ICAI since 2009. He's also assisted in the preparation of the study material on direct and international taxation for ICAI and vetting of CA journal articles and India annual budget updating on international taxation. And he's also a part of the online ICAI initiative on Q&A on direct and international tax matters. And he has recorded various lectures for ICAI final year students on direct and international taxation. We could not have selected a more apt person for addressing us today, sir. Thank you very much for sparing your time and welcome to SARC again. Over to you.
Namaste, Retiji and Mr. Pannaraju. Am I audible? Is it okay?
Yeah, yeah, you are.
Okay. So thank you very much for inviting me on such a wonderful platform, which I always love to be at. And also all the attendees, and I could see the number increasing each second. So thank you very much for attending this very, very important session on the residency rules. And thank you, Revati ma'am, for giving such an elaborate and beautiful introduction. Thank you very much. So I straight away start with my presentation. Thank you.
Visible, sir.
Yeah. So is it is my presentation?
Yes, sir. Visible, sir. And please continue.
Visible? Okay.
Yes.
Thank you. Thank you. Okay. And I request all the participants if they could also keep the Income Tax Act readily available with them, and also a notepad and your pencils or pen. I'll give you a couple of minutes to be ready with your act. It could be, you could have a act in the hard format or whatever way you feel like. Okay. मेरा अब शुरू हो Okay, so we start with the presentation. Yeah. The topics that we are going to cover, and feel free to tell me if you are not able to hear me properly.
No, sir, it's fine, sir. It's fine. You can continue. Please.
Okay, fine,
Very much
fine. Okay, so we are going to talk about the new residency provisions, which of course we are applicable starting from 1st of April 2020. Also, we are going to talk about the international residency provisions, covering in particular the double taxation avoidance agreement that we have with USA. Also, the return filing obligations in India and also abroad. I'll talk about the return filing obligations in USA. Also, the disclosure of overseas assets while we file the income tax return in India, as well as in case we are filing the returns abroad, in particular USA. Also, the issues and cautions that we have to be very careful while doing our tax returns in India and in USA. So let's start with the residential status, which is very, very important to understand from the Indian income tax perspective. Because if we understand section 6, believe me, lot of the understanding of international residency provisions will also be very, very clear. So therefore, let's get on to the provisions of section 6. Section 6 is considered to be a bridge between section 4 and 5. So what is section 4? Section 4 is the charging section. And you have to just bear with me because I'll be little bit more like like we do in a class. So section 4, the head is base charge of income tax. It has two sub-provisions. Section 4.1 talks about the chargeability of income tax in respect of the total income of every person. So section 4 subsection 1 says that total income in every person will be the subject matter of determination of charging of income tax. And equally important, subsection 2 of section 4, it says that in respect of income which is chargeable under subsection 1 shall be deposited, the income tax shall be deposited either by way of an advance tax or by deduction of tax at source. So keep these two subsections in mind while we proceed further to section 5. Section 5, and this is all covered under chapter 2 of the Indian Income Tax Act of 1961. Section 5 provides the scope of total income, and it defines the scope basis the residential status of a person. Again, we are going to read section 5. And section 5 says that total income of any previous year of a person who is resident in India includes all income from whatever sources derived. Underline this word. A person who is resident includes all income from whatever sources derived, which A is received or deemed to be received in India in such year by or on behalf of such person. Okay, so received. In case a resident is receiving in India or deemed to be receiving in India, it is covered under total income. Number 2, accrues or arises or deemed to accrue or arise to him in India. Him here includes her in India during such year. This was also covered by Sudarshan sir yesterday, section 9, the deeming provision. And third, accrues or arises to him outside India during the year. So very, very important to remember these three sub clauses for a resident and a person who is an ordinary resident. Received, accrues or arises to him outside India. It will all be considered as total income for the purposes of section 4. There is a proviso in section 5 subsection 1 that in case of a person who is not ordinary resident, the income which accrues or arises to him outside India shall not be included in total income unless that income which arises to him outside India is controlled in India. Okay, so this is the distinction between ordinary resident and not ordinary resident total income. And for all of us, very important is subsection 2 of section 5. It says that total income of a non-resident. Now, please underline the non-resident, subsection 2. All income from whatever sources derived, which is received or is deemed to be received in India in such year, and or accrues or deemed to accrue or arise to him in India during such year. So section 5 clause B, subsection 2 clause B takes us to section 9. So with this clarity in mind, section 4 we are clear that income chargeable to tax. Section 5 defines what is covered for a resident, a not ordinary resident, and a non-resident. We move on to the most important section, which is section 6. We are still part of chapter 2, basis of charge. Section 6 provides the test for determining the residential status of a person. It is considered to be the backbone of the Indian Income Tax Act. Once we are clear with what section 6 is, believe me, the understanding of the act becomes very, very clear, not just from the domestic perspective, but even from the point of view of understanding the international tax law on the residency provision. Before I talk about section 6, one very important thing to be kept in mind is that double taxation avoidance agreement, as also touched upon by Sudarshanji yesterday, is fully dependent on your residential status. For example, an individual who has been in USA since last 10 years and he visits India maybe for 3 weeks or 4 weeks in a year, which is around not more than 30 days in a year. And he has a transaction, a business transaction he executes from America with some Indian company. And I'll take a more tangible example here to make the DTA more clearer on this. So an individual named Mr. Rameshwar Das, he is a civil engineer, currently based a resident as well as the citizen of USA. He enters into an agreement with the BHEL of India for advising on certain civil matters, civil engineering matters. He, of course, was the Indian origin person, and still he is an Indian origin person. He was at some point in time a citizen and resident of India, but currently he is based out of US and therefore the resident of US. Whether the TTAA would be applicable on him or not, this is the determining factor for applicability of DTA. And DTA says that to find out, the DTA says that DTA will only be applicable between the residents. So Rameshwar Das has to be resident of USA in case he wants to avail the benefit of the DTA between India and USA. DTAA says that to determine the residential status, check the domestic act of the state where he is currently residing. So Rameshwar Das is residing in USA, and as per the domestic law of USA, in case you are residing in USA in a particular year for more than 182 days, or you are a citizen of USA, you have obtained the citizenship of USA, and therefore you become a resident of USA. So DTA says that if as per the domestic act of the jurisdiction or the state, you become a resident, then yes, the DTAA benefit can be availed. So Rameshwar Das, complying with the DTAA and the Domestic Act provisions of USA, becomes the resident of USA, and he can avail the benefit of DTA as available to the residents. So this is what the definition of residential status is. So the point which comes out is that Domestic Act becomes very, very important to determine the residential state. So therefore, Section 6 is not only important for us to understand the Domestic Act or the provisions of Indian Income Tax Act, but also from DTAA perspective. So let's travel to this section more elaborately now. So number one important point is that test under Section 6 is applicable to the previous year for which status is to be determined, which means that residential status under the Income Tax Act is to be computed every year. It cannot be presumed to be same in the subsequent year. So residential status under the Income Tax Act is different, slightly different from the residential status as given under the other enactments like Foreign Exchange Management Act or the Companies Act, though more or less they are in line with the Income Tax Act. And one very important point is that, like we are going to talk about 182 days or more, consecutive stay is not required while we determine the residential status. It is the aggregate stay in India. And again, for all of us to note that the day of entry into India and the exit day will be included while calculating the aggregate stay in India. And as far as Income Tax Act is concerned, purpose of stay in India is not relevant. However, for FEMA purposes, purpose of stay is equally relevant. But in nutshell, this is what the residential status object is. Again, I would request you, if you are having the Income Tax Act with you, Section 6(1) is the charging section or the section for determining the residential status of an individual. An individual is said to be resident in India in a previous year if he satisfies either of the following two conditions. Condition 1, as we all know, if he stays in India in that year for an aggregate period of 182 days or more. An example, a very short example, Mr. Kevalam, he has been an Indian resident, and during the previous year, which just ended on 31st March of 2021, he was stuck up in Dubai for around 100 days. But still, he was in India for 260 days. And of course, he was always in India before that. So, in this case, his stay in India is exceeding 182 days or more. So, he is a resident of India. But just reverse the situation. He was stuck up in UAE because of the pandemic and flights not available, and because of his medical situation. His stay in India was just 100 days during the financial year starting April 1, 2020 to March 31, 2021. Past years, he has always been in India. Would he still be considered as resident? We have to move to condition 2. So condition 2 is, and condition 2 starts with a very beautiful word, section 6(1)(c), clause C. It starts with the word having, a beautiful English language, I would say. It says that having within the 4 years preceding that year, that is preceding financial year 2021, he was in India for an aggregate period of 365 days or more, and in that particular year, that is in the financial year of 2021, for an aggregate period of 60 days or more. Yes, he Kevalam satisfies this condition because except for financial year 2021, in earlier years, and in fact in more than 4 years, but definitely in 4 years, he was in India for 365 days or more, and in the financial year of 2021, for an aggregate period, this is what we just saw, he was in India for 60 days or more. So he satisfies condition 2, and therefore he is resident of India. So this is how we determine the residential status of an individual. Number one, to look at the provisions of 6 subsection 1. If he turns out to be a resident, then the next step, which is equally important, is to ascertain whether he is a ordinary resident in India or not ordinarily resident in India. So step 1, as we just mentioned, that first step is to determine whether he is resident or non-resident, and if he turns out to be resident, then we go to resident and not ordinary resident. So step 1, as we just discussed with example, again it is mentioned here, but I would like to highlight the explanations which are given under section 6 subsection 1, and very important explanations. Under the Income Tax Act, as we just discussed, if he satisfies any of the conditions, one or both, he becomes a resident. Two very important explanations given, and this is termed as explanation 1 to subsection 1. In case of an individual, very important that if an individual who is an Indian citizen, if he is an individual Indian citizen and a person of Indian origin, okay, so Indian citizen and a person of Indian origin, both these conditions go simultaneously, who visits India during the year. So Rameshwar Das, who visits India during the year, the period of 60 days which we just saw, that 60 days, 365 days in preceding 4 years, etc. This 60 days is substituted with 182 days. I'm taking more time on this so that the basics are very clear. Rameshwar Das, for example, during the financial year 2020-2021, and as we discussed, he has been in US for last 10 years or so, and 30 days is approximately the number of days that he spends. But during financial year of 2021, he was in India for a period of 181 days. So the 60 days condition, he would, and let me also again fine tune this example furthermore. He has gone to US and in last 3 years only. Okay. Last 3 years he has shifted to US. So during last, in fact 4 years, he has shifted to US. So he was in India during last 4 years for a period of 365 days or more. And also during the previous year, he was in India for a period of 60 days. But he would not be considered as resident because this 60 days, the and condition is substituted with 182 days. Because he is a Indian origin person, an Indian citizen, and he is on a visit to India. So 60 days gets substituted with 182 days, which means to become a resident, apart from 365 days condition in India, we have changed the example. He was in India for more than 365 days in 4 years. He was to become a resident 365 days plus he has to stay in India for more than 182 days to become a resident and ordinary resident. Okay, this is condition which is to be very, very important, and a person who is on visit to India. And similar concession is provided to under explanation 1 again, clause A, to Indian citizens. Here we are not talking about person of Indian origin, only Indian citizens who leaves India in any previous year. Say he leaves, the other example Kevalam, he leaves India during financial year 2021 as a crew member or for the purpose of employment outside India. 60 days gets substituted with 182 days. So Kevalam, he leaves India, and he has of course been in India for last so many years now. He leaves India on 10th of September 2020, and he has left for Australia for employment, for good. And he satisfies condition number 2, that he has been in India for 365 days or more in 4 immediately preceding years, and also he is in India for a period exceeding 60 days. But because he has left for employment, 60 days gets substituted with 182 days. So in the previous year, he was not in India for a period of 182 days or more. So therefore, he is not a ordinary resident in India. So this is step 1. Very, very important amendment which has come. And I'm talking about the person of Indian origin and Indian citizen who visits India during the period, wherein 60 days were substituted with 182 days. So there is a very important amendment to this. And this amendment is effective from assessment year 21-22, and I'm sure most of us would have already checked and applied this. That the period of 60 days shall be substituted with 120 days. As we mentioned, that 182 days is what is the period which is applicable. This is substituted with 120 days if let me just put my phone on is substituted with 120 days if the person who is an Indian citizen or a person of Indian origin whose total income other than the foreign source income exceeds rupees 15 lakhs during the previous year. Let me go back to, however, in respect of Indian citizen or person of Indian origin, example again. So Rameshwar Das visits India during the previous year. Without exception, 182 days was what was allowed to him. But Rameshwar Das also has Indian income arising from house property, rental income, interest income, and he is a regular tax return filer in India, and his income is around 20 lakhs 20 lakhs income in India. So 182 days will be substituted by 120 days here. So, and this is in lines with the international tax provisions called BEPS, base erosion and profit shifting, and also MLIs, the multilateral instruments which India has signed with number of countries. So which means that you become a resident, may not be not a resident, but not ordinary resident, but not non-resident. Huh? In all other cases, he remains. So without exception, the last 2 points, 182 days or employment outside India, he becomes a non-resident. But as soon as he has an income in India exceeding 15 lakhs during the previous year, and here we are talking about total income, huh? Exceeding 15 lakhs during the previous year, 182 days is substituted with 120 days. So Rameshwar Das, having total income of 20 lakhs in India, he has been in India for a period exceeding, to be very precise, he was in India for a period of 180 days during previous year. So he becomes a resident and not ordinary resident. So he is no more a non-resident in India as far as previous year of 2021, that is assessment year 21-22 is concerned. And as we all know, as we just discussed under section 5, the difference between resident, not ordinary resident, and non-resident, the implications would apply accordingly. And 15 lakhs is not about a threshold limit or a taxation limit. It is only a limit to determine his residential status. And income from foreign sources means income which accrues or arises outside India, except for any business which is controlled in or profession which is set up in India. Feel free in case you have any questions, because now it is getting on to more technical. Okay. And also a very important section which was introduced by the Finance Act of 2020. I'm again going to repeat what we have just discussed for the benefit of better understanding. So section 6, subsection 1A, it provides that an Indian citizen shall be deemed to be resident in India only if his total income other than foreign sources income exceeds 15 lakhs during the previous year. So if you already have the act before you, please mark section 1A, subsection 1A, to be read very carefully. So it provides that in case you become a resident in India and not ordinary, in case you have income exceeding 15 lakhs during the previous year from the Indian sources. And equally important point is, why are we making him resident in India, a resident but not ordinary? Another condition which is given is that he shall be deemed to be Indian resident only when he is not liable to tax in any other country or jurisdiction by reason of his domicile or residence of any other criteria of similar nature. Let me explain these two bullets with the help of an example. And this example
Hello.
Am I audible now?
You're audible, sir. I'll give you the presenter rights back. 1 minute.
Okay. Okay.
You can start sharing the screen, sir. So, if there is any question, can we take up now, or else we'll take it up after the session, sir? At the end of the session.
Yeah, I think let's take up now. Let's take
I'll share my screen.
up now. No, we can take up now if there's anything, because this is very relevant topics that we have covered.
Compiled it. I'll share my screen. So there are 1 minute. Yeah. These are the questions. I hope my Excel sheet is visible, sir.
Yes.
Yeah.
So how long an NRI who become resident based on the period of stay, his deposits in NRE account, can he keep it as long as he has the intention to go abroad? Kindly clarify. Okay, so I'm just going to answer this little shortly. You have mentioned that the day of arrival in India is to be included, but there are several decisions. Yes, you are right. There are several decisions, but of late, considering the BEPS provision and the MLI provisions, to avoid any kind of a gap, because the arrival and the departure is generally not included by the other nations. So the Domestic Act has been enabled to consider it as a days to be included. So I agree that there are a number of cases, but of late, this is what the new cases are. For financial year 2021, the law doesn't give any relaxation if anybody is stuck up in India. Yes, you are right. There were relaxations during the earlier year, but not this year. And in the situation, if it arises, there is a form which is prescribed, which is referred to as form, I guess, NR. So if somebody is stuck up in India and he files that form with the revenue authorities, so I'm referring to question 3. If he files that form giving the reasons and he gets an order that, okay, this relaxation applies to you. So NR form becomes very, very important here. So of course, not by way of any new circulars, but because of the previous circulars. Question number 4, in the context of various models of taxation, residency, what is the rationale of incorporated? Okay, so again, question 4 also, not now. If a person leaves for an employment in US, the period of 60 days needs to check first year of leaving India or every year? No, first year. Of course, as we mentioned that section 6 is to be determined every year, the residential status, but 60 days would only be applicable in the first year, because second year onwards, it could be the situation could change. Is the NRE deposit and its income come within the purview of foreign sources? I'm going to skip this. This I'm going to answer once individual is done. Question 7, a person non-resident, person of Indian origin, stays total of 200 days for last 10 years, but from 1/4, how many years he can claim status of RNROR? Maximum 2 years that he can claim. Income from NRE FCN, I can see a lot of questions. So they must be coming from the participants from South, because this is something very, very common. And I'm going to address this little later. So I guess more or less the questions are answered.
Yes, sir. I'll give you the percent rates back. You can start.
Yeah. So is my site okay? Is it visible?
Yes, sir, please.
Okay. I don't know where I was stuck up, but yeah.
Yeah.
I think this was the site where we were stuck up. Yeah. Okay. Was this clear? Amendments? 15 lakhs, 120 days?
Yes,
yeah. Okay. No, not a challenge. Let me start with the new section 6(1)(a).
Yeah, just stuck up for last 10-20 seconds only, so then automatically I gave you a call straight away.
Okay. Not a problem. So what is this section 6 subsection 1(a)? And this section starts with notwithstanding anything contained in clause 1. So 6 clause 1 that we read, it says notwithstanding anything there. An individual being a citizen of India, having total income other than the foreign sources income exceeding 15 lakhs during the previous year shall be deemed to be resident in India. Underline the word deemed to be resident in India. In that previous year. So 15 lakhs, 120 days deemed to be resident in India in that previous year if he is not liable to tax in any country or jurisdiction by reason of his domicile or residence or any other criteria of similar nature. What is the meaning of this? "15 lakhs, 120 days, deemed residency." What is the meaning? The meaning can be explained through an example. So this gentleman's name is Mr. S. Mr. Sarvikar. Sarvikar. Sarvikar is a very smart person, Indian origin guy, Indian citizen, in fact. So this person, with the help of his professionals, used to stay in 4 countries during any financial year. Generally, his stay in Dubai was around 115 days. In India, he was again there for a period exceeding 100 days, but always within 110 days. So total stay between Dubai and India was around 210 days. He was having his business in India, running from Dubai, and vice versa. And the remaining days, the remaining 155 days approximately, he was either in Singapore or Malaysia, spreading his days equally in those countries. So he was never a resident of any country in India because of the conditions that we just discussed. In Singapore, again, he was not having any income. Malaysia, nothing. Dubai, anyways, is a tax-free, and again, he was also not a resident of Dubai. He was able to avoid being a resident in any country and enjoy the tax-free incomes. So to bridge this loophole, the BEPS has provided that Domestic Act be sufficiently amended to at least bring their citizens or person of the Indian origin to be deemed resident of India. So therefore 61A was introduced to curb this kind of a loophole. So let me read it again. 61A, it says, notwithstanding anything contained in clause 1, an individual being citizen of India, having total income other than income from foreign sources exceeding 15 lakhs during the previous year shall be deemed to be resident in India in the previous year. Of course, it is to be checked for every year. If he is not liable to tax in any other country. Okay, so does it make sense? 61A. Thus, from assessment year 21-22, an Indian citizen earning total income in excess of rupees 15 lakhs from Indian sources shall be deemed to be resident in India if he is not liable to pay tax in any country. Please read these 3 bullets carefully. I give you 30 seconds to again go through these yourself. Liable to tax has not been defined anywhere in any of the acts of any country. But this is a word which is used very frequently in the Indian Income Tax Act, in DTAAs. For the first time, by the way of Finance Act of 2020, a section 2, clause 29A was introduced to define liable to tax. Liable to tax in relation to a person, not just individual, in relation to a person, and with reference to a country means, so here say India, it means that there is an income tax liability on such person under the law of India for the time being in force. And it includes a person who has subsequently been exempted from such liability under laws of India. Let's understand it with the help of an example. Who is liable to tax? So, a person called Kevalam, he is having income in India, but his total income in India is around only rupees 200,000, 2 lakh of rupees in India. So question number one is he liable to tax? Is there a tax liability on such person under laws of India? The answer is yes. Though he has been subsequently exempted from such liability because the threshold has been set at 250,000 rupees, but he is liable to tax, though exempted subsequently. So liable to tax and payment of tax has been distinguished by way of definition of liable to tax. He may not be paying any tax because of the subsequent threshold exemption. Similarly, Dubai, there is no payment of tax per se. But does it mean that there is no liability to pay tax? No. Everybody is liable to pay tax, but there being no income tax per se, there is no payment of tax. Everybody automatically gets into that exemption. Liable to tax, they are yes. In KSA, Kingdom of Saudi Arabia, except for oil countries which even land up paying nearly 98%. But otherwise, yes, everybody is liable to pay, but there being no enacted income tax, the payment doesn't arise. So liable to tax means the income tax liability, provided your incomes are as per what we just discussed, section 5 and total income definition, you become liable to tax. You may be exempted from payment, that is another aspect. Okay, so liable to tax. Now, we are now repeating number of times, but to make it very, very before I move on to some other very, very important provisions. So whether resident or not ordinary resident, so person, individual resident will be treated as resident and ordinary resident if he satisfies the following conditions. He is resident in India in at least 2 out of 10 years immediately preceding the previous year, and both the conditions are to be satisfied. His stay in India is for 730 days or more during 7 years immediately preceding the previous year. I'm skipping the example here because this we all understand. Let me come to the not ordinary resident. An Indian citizen or a person of Indian origin whose income other than income from foreign sources exceeds 15 lakhs and who has been in India for a period of 120 days or more but less than 182 days, he would be considered as deemed resident, a resident but not ordinary resident. Similarly, an Indian citizen, so above one was for Indian origin and citizen of India, that is persons on visit to India. An Indian citizen, only for Indian citizens, will be deemed to be resident in India but not ordinary if he fulfills the conditions as laid out in section 6 clause 1a. Clause 1a, if you recall, is if he is not resident in any other country, then he would be deemed to be resident in India. And as we discussed in the beginning, the determination of residence is very, very important from DTAA point of view. Because if you're a stateless person, you cannot avail the benefit of DTAA. So 61A helps in bridging that gap. So a resident individual who does not satisfy any of the aforesaid conditions or satisfies only one of the four will be treated as resident but not ordinary resident. Okay. So let me now summarize the provisions with the help of an example. So provisions relating to tax residency. I know we are taking a lot of time on this, but this is very, very important for all of us to understand. So Indian Income Tax Act, the individual is considered to be resident if he is in India for a period of 182 days or more. Example, what we have just discussed. And second is his stay in India, say during financial year of 2021 was 212 days, and in other country 153 days. He would still be tax resident during the financial year of 2021 as his stay in India is 182 days or more. And if we compare it with the country Bahrain, where the revenue authority is Minister of Finance and National Economy, more or less the same conditions, the applicant must be present in Bahrain for a period of not less than 183 days in total in that year. Again, they are talking about aggregate and as required for the residency certificate is the word that they have used. India doesn't use the word residency certificate. The CAs on their own, checking the passports, visas, etc., can determine the residential status. But there in Bahrain, you have to have the residency certificate determining that you were in Bahrain for a period not less than 183 days. So again, with the help of example, we can determine whether he is resident of India or Bahrain. Again, this example we just discussed in a under different name and different country, but it is again about the 15 lakhs income, and we just noted that such person becomes resident but not ordinary resident. This again we have discussed with the help of an example, but I have just summarized these bullets here, and I would request if you could just read it. So again, an individual who comes on a visit to India in any previous year shall be considered as resident if his stay exceeds 120 days and he has Indian income exceeding 15 lakhs. If such individual has Indian income as nil or below 15 lakhs, he is allowed to stay in India up to 182 days and still being considered as non-resident. If 120 days, 15 lakhs, then he becomes a resident but not ordinary. So understand the difference between these two bullets. Okay, so before coming on to the company, let me talk about the banking accounts. So as soon as an individual leaves India for good, for the purpose of employment outside India, employment could be job or your own profession, or settling outside India on immigration, etc., and you are clear about it, or 6 months have elapsed, then all the Indian bank accounts in the name of savings, current, FDs, they have to be converted to the non-resident accounts. Savings account generally gets converted into not non-resident ordinary account, which work as a savings account, but with more disclosures. A non-resident Indian can also open a non-resident external account or FCNR account. So non-resident external or FCNR accounts are generally the foreign currency accounts. You can maintain the balances in the foreign currency, and they are as good as your ordinary account in the country in which you're staying. Deposits or interest that you earn on NRO account is fully taxable in India, and in fact the banks deduct the taxes at the maximum marginal rate unless you give them the tax residency. If say you are in US of USA, that you are tax resident of US, then they may deduct the tax at the rate of 10%, otherwise 30%, if the deposit or the interest is from the NRO account. But if you have maintained deposit in NRE account, then the interest earned thereon is not taxable in India. It is in fact an exempt income per clause of section 10. Okay, so any interest earned on FCNR or NRE, it is in fact tax exempt. Once you come back to India, till you are maintaining the status of not ordinary resident, the interest remains tax exempt. So generally for first 2 years, I would say that if you have come to India now, and of course your stays have been long, more than 10 years outside India. So first 2 years, any interest earned on NRE or FCNR, it still remains exempt. But generally you cannot renew. Suppose you have come to India and the NRE deposit is due for renewal, you cannot renew it as NRE deposit if you have now come back to India. But till it is in NRE status, maximum up to 2 years, it becomes tax exempt. Similarly, if you have kind of any other interest income, or let me take it from another example. So if you have, once you are becoming a non-resident, you have to keep your banking authorities or the institutions where you have deposited money, the change in the status, because henceforth they would be deducting, irrespective of the amount, the taxes as applicable to non-residents as per section 195. For example, if you have a deposit with any domestic company in India, the interest on which is 10,000 rupees or less, so they are not deducting any tax at source currently. But as soon as you become non-resident, inform them. So even on a rupee paid, they will have to deduct tax. If you have any kind of a life insurance policy, Mediclaim policy, do keep these institutes aware about your status. Something happens, you are non-resident declared, then it would be very easy for you to claim the benefits arising out of such policies. Okay, so this is about individuals. And now let me come to the residential status of a company. This the remaining will take us around 20 minutes, and then I'll take up all the questions in last 10 minutes. How to determine the residential status of a company? The amendment was made in by way of Finance Act of 2016, and it was effective from assessment year 17-18. A company is said to be resident in India, and I'm again on section 6, subsection 2. With effect from assessment year 17-18, a company is said to be resident in any previous year. Always remember the first slide that every year is an independent year if it is an Indian company. So a company which is incorporated in India and which is established in India to work in India is an Indian company. So it is always considered to be resident in India. Just an example here. So we have set up a company which is wholly owned by an American company. The parent company is an American company, but it is set up as per the provisions of the Companies Act of 2013. Such company would always be an Indian company and resident in India. Okay. Another example, a foreign company has set up a liaison office in India. And as you all know, liaison office is always set up in the name of the foreign company. And it is always considered as a foreign company. Liaison office. When you are filing the return, yes, it's established and it is documents are filed with ROC, but as a foreign company. And of course, liaison office doesn't have any taxable income, so there is less dispute with regard to the residential status. But for all practical purposes, for all purposes of DTAA, it's a foreign company. A foreign company has set up a branch office in India, again, or a project office in India. And as most of us practice in establishing, again, the branch office is established in the name of the foreign company's name. Taxes are different. The taxes are levied as per the provisions of the foreign company. They are liable to pay taxes at 40%, with some amendments coming in during this year. So branch office is always a foreign company. As Sudarshan sir in brief touched, that liaison office and branch office per se are the permanent establishments. Okay. So Indian company set up in India, any foreign company registered in India would still be foreign company. 1718 has added an other clause for a company to be resident in India, and that clause is that if a company has its place of effective management at any time, underline the word at any time in that previous year in India, it would be considered as a company resident in India. I'll go to the circular in the next slide. But before that, and this is very, very common between somebody asked about the tax havens, that what is the relevance of tax havens. So if a person who is resident of India has set up a company in Dubai for doing certain trading activities, or maybe doing some manufacturing with the help of local people there, but effectively he is sitting in India, he is resident of India, managing the affairs of that company in India, that company which is in Dubai will be considered to have the effective management at any time in that year in India and will be the resident in India. Very, very recent examples, I'm sure you would have read it in Economic Times, Mint, etc. That lot of companies set up by these multinational entities, including HUL and GSK, Reckitt Benckiser, in places like Nepal, Bangladesh, Bhutan, with management being with the Indian directors. So, because of this amendment, the companies which are established in those countries, they are now considered as resident in India. And in fact, and this as we are dealing with all such companies, they are liable to tax in India. The incomes are included with the Indian company now, and any taxes that they have paid outside India, we give the credit of it. Okay. So this is a very, very important amendment which has to be kept in mind while we determine the residential status of a company. So what is this? How do we determine the place of effective management? The circular which had come out on this regard, which the reference is given in the next slide, it says for determination of poem or pen, we call it place of effective management. But to make it more interesting, we can also call it poem, place of effective management. Circular says that company, or let me just, okay. Circular says that the company which is engaged in the active business outside India, active business, will only be considered for the purposes of determination of residential status. So if company is engaged in the active business outside India, poem outside India, if the majority of board of directors meetings are held outside India. What is active, what is passive, we are just going to see. So if a company is ABOI, active business outside India, yes, they have active business outside India. Poem will be outside India if the majority of board of directors meetings are held outside India. And please remember that de facto decision making authority, if it is not BOD but Indian parent or resident, then this test fails. They would be considered to be having poem in India. If board of directors are just employees doing just regulatory compliances or procedural aspects, but the decisions are taken by Indian parent or resident, then this test fails and the such company becomes resident in India. If that company is not engaged in active business outside India, no, we have to identify the persons who actually make the key decisions and commercial decisions. Underline the word key management and commercial decisions. And also determine the place where decisions are in fact made. Okay, we are going to talk about it a little bit more. No poem for active business outside India unless proved otherwise. This we are going to talk in the next slide. So step one for determining the poem in India is that the company should be engaged in active business outside India. Trading, manufacturing, services, they are all active business outside India. Okay, let's move on to the next slide. What is active business outside India? So active business is where your passive income is not more than 50% of the total income. What is passive income? So passive income means income by way of royalty, dividend, capital gain, interest, rental income. If this is included in your total income, this would be considered as passive income. And this we all know actually, royalty, dividend, capital gain, interest, rental, etc. It is all passive income. But another very important addition to passive is income from transactions where both the purchases and sales of goods is from or to the associated enterprises. So where these kind of incomes are included in the total income, then it would be considered as the passive income. So active business outside India, the first condition is that your passive income is not more than 50% of the total income. And less than 50% of the total assets are situated in India. Total assets means immovable as well as movable assets. It includes your fixed assets, your debtors, your creditors, your deposits, advances, etc. Less than 50% should be situated in India. And these are all cumulative conditions. And less than 50% of the total number of employees are situated in India or resident in India. And payroll expenses incurred on such employees is less than 50% of its total payroll expenditure. Read it again very carefully. Active business is very important, as we saw that only companies which are involved in active business, the determination of poems becomes very, very important. So active business means your passive income not more than 50% of the total income and less than 50% of the total assets are situated in India, plant, machinery, your other movable assets situated in India, and less than 50% of the total employees are situated or resident in India, and equally important, payroll expenses incurred on such employees is less than 50% of the total payroll expenditure. If all these conditions are cumulatively fulfilled, the poem will not be considered to be in India. Okay, so this is what the companies is. In next 5 minutes, I guess I'm just running short of time. The filing of income tax return. I would also request, as I would not be able to really cover, but just for your own help, you must read the provisions of section 115, the determination of taxes in certain special cases, which is chapter 12. Okay, so let's come back to the provisions relating to the ITR filing in case of a non-resident individual and companies. NRI or not, this we all know that in case the income exceeds 250,000 is required to file tax return. So I'm not talking about an example, an NRI having a house property in India earning rental incomes would be required to file an income tax return if the rental income exceeds exemption amount. So this is very important. In case he has rental income of only 2 lakhs, there is a tax deduction at source of 30%. He is not required to file return. The requirement will only come if his rental income exceeds the threshold limit. Taxes is applicable to NRIs for the following types of income, which I think we have already discussed. Income which accrues or arises, which is deemed to accrue or arise, which is received, or which is deemed to be received in India. So an NRI is not required to file income tax return while having income in India only if the specified conditions are fulfilled. So as I mentioned, do refer to section 115 to understand. The specified condition is that the NRI's total income in the financial year should only consist of investment income. So if a NRI has dividend income or interest income on which the taxes have been deducted at source as per the Indian Income Tax Act, then in such cases, the tax return, even if the threshold is exceeding 250,000 rupees, is not required to be filed. So keep these specified conditions in mind while filing the tax return. And of course, the due date remains same as applicable to the residents, that is 31st July. In case he's a partner, then 30th September, and he can always file a belated return. These dates, of course, are subject to any changes which CBDT makes from time to time. Online return can be filed, and under your digital signatures, and as this I think is a very common we have been filing, so not very important. Let's talk about the disclosure of overseas assets, issues and cautions. AL schedule is applicable only if the non-resident individuals have the total income exceeding 50 lakh of rupees. They are required to report movable as well as immovable in Schedule AL while filing the income tax return in India. However, in the case of non-resident, underline the word non-resident, and resident but not ordinarily resident, RNOR, the details of assets in mentioned located in India. So not the overseas AL schedule facilities, resident and only assets which are located outside India. Similarly, where directorship in a foreign company having no source of income in India is required to be disclosed, as we all know that we have to disclose the directorship in companies that we are holding. But in case of NRIs, if he is a director in a foreign company and such foreign company has no sources of income in India, such company's disclosure is not required to be made in the tax return. So a non-resident taxpayer who is director in a domestic company and a foreign company, and the foreign company does not have any sources of income in India, such NRI will only provide the details of directorship in Indian domestic company. Then there is a question, do you have a bank account in India in order to claim refund? So earlier there was a challenge that in case you do not have a bank account in India, the refunds used to travel a lot or rejected. But now with effective assessment at 21-22, you can always say no, I do not have a bank account in India, and you can furnish the details of your overseas bank account. And as we just discussed, foreign assets are not required to be disclosed if they are located outside India. The disclosure is only limited to assets and incomes which have a nexus with India. So this was the presentation as far as the non-resident Indians is concerned. So I'm just stopping my presentation, and I'll take up any questions that you have in the remaining 5 minutes.
Yes, sir. I'll share my screen.
Yeah, sure. Let me just stop this.
So we skipped some question here. So do we take it up now or else?
Yeah, we can now take up all the questions. Yes.
Yes. So from 1 onwards, it seems first one is
Yeah. So I think question number 1, we have already answered. How can an NRI who become resident? So 6 months is the period which is allowed. After that, he must open his NRO and NRE accounts. So we start with section question number 9. No. So first one is answered. Yeah. I think fourth one also was the one which, question number 4. In the context of various models of taxation based on jurisdiction residency, what is the rationale of organizations getting incorporated in tax-free? This is a very, very interesting question. See, before BEPS and MLI, or for example, the case of Vodafone, which Sudarshanji also took up yesterday, the benefit is that if in case you are in a tax-free jurisdiction or the so-called tax havens, or the countries with very low tax rate like Mauritius, the benefit is that if you are resident of that country, your incomes arising from dividend, capital gains, they are, or royalty incomes also at times, get taxed at a very negligible or a nil rate. Therefore, the advantages of setting up or incorporating in these tax havens. But this is the history now. With coming up of BEPS, the base erosion and profit shifting, and MLI provisions, which is one of point number 15 of BEPS, these are now going to get reduced significantly. Yeah, so we can move on to the next point. If a person leaves for employment, the period of 16 needs to be checked. Yeah, this I think we answered. Is the NRE deposit and its income comes within the purview? Yes, it comes within the purview of foreign sources. So we can move to next question. Beyond question number 7, yeah. Question number 8, 6(1)(a) 15 lakhs and not liable is both the conditions to make a resident in India. Yeah, you have to read section 6(1)(a). It is for citizens of India and the person who is not liable to tax in any other country. 6(1)(a) is applicable only in those cases. 15 lakhs is for the person of Indian origin or Indian citizen who is coming on visit to India. In his case, 182 days becomes 120 days. So this is how the distinction is to be made. 6(1)(a), will a person falling under be treated as no? 6(1)(a), he will always be RNOR, as we discuss in the subsequent slides. What if the change of residency is not informed to say banks to avoid TDS? In case it is not done, there are very serious implications. Particularly as professionals, we must advise our client that in case banks are not deducting the right taxes, the tax liability, despite his depositing the entire tax, may come on such non-resident with a lot of interest and penalties and litigations. So not informing to avoid the TDS is very, very serious. And effective 21-22 with the BEPS and MLIs coming in force, we have to be very careful and correctly informing our clients. Many US companies establish their wholly owned subsidiary private in India as their development centers as totally controlled, managed by, will be treated as domestic or no. Again, as we discussed, if it's a wholly owned subsidiary, it's an Indian company. If it's purely a liaison office, then it is a non-resident company or a foreign company. So if there is a development center, I do not know what this development center does. If it is a, if it is not into manufacturing, but some kind of advisory or research, then it may very well fall under the liaison office. No taxation in India, but return would be filed. What if the change of residency from resident to NR is not informed to, say, banks? This I think we have already answered. Next question, question number 14. Yeah, so I think this is it. Any other questions? We still have a couple of more minutes.
There's one question. This one.
14. Is NRE FD interest continue to be exempt from tax till its maturity, even though the residential status? Yeah, I think this we already discussed, that NRE FD interest continues till you are not ordinary resident. However, if it matures while you are already in India for good, then exemption doesn't continue. You cannot continue with the NRE deposit. A resident who has been working abroad is in possession of ESOP sweat being allotted every year and TDS deducted. Will he be required to disclose the same? Yes, if he has the nexus, if the ESOP and sweat was allotted to him while he was an Indian employee, then to that extent, yes, it will be required to be disclosed. But if the sweat or ESOP or RSUs are allotted to him while he was employment abroad, that need not be disclosed. India has a DTA with that country, yes. So that's fine. Yeah. Any other question?
Those were the questions, and we also confirm. Ma'am, over to you.
Okay, so I think.
Ma'am, unmute yourself.
Great. So we have been able to achieve our time limit.
Yes, ma'am.
Yeah, I'm unmuted. Thank you very much, Jai Kumar sir, for generously sharing your time with us early in the morning. I'm sure the 500 plus participants is proof enough of the, your delivery, as well as the importance of the subject on which you have spoken and shared your knowledge and taken the time to also clarify all the questions. We are very, very grateful to you for having accepted our invitation and come here to share your knowledge with us. These recordings will actually be posted on YouTube, and whatever other queries, I think we can always, reach out to sir independently and get our clarifications. Thank you very much, sir, once again. Thanks a lot.
Thank you very much. Thank you.
Thank you, sir. Thank you. Yeah.
Okay. Thank you.
We have
Thank you.
speakers. See, Rajendra Prasad have joined the session. He will be.
Oh, he joined the session? Okay, fine. Okay. Yeah. So friends, we will move on quickly on to the next session where the speaker has already joined with us. 1 minute. Yeah.
Sir, you can turn on your video, sir. Possible.
Yeah, okay.
Yes, sir. Screen is visible, sir.
Screen is okay?
Yes, sir, visible, sir. Can you put it in slideshow mode, sir? Yes, sir. No, the video is not it. So visible, sir.
Visible? Hello, hi, good morning.
Yeah, good morning, sir. Good morning, Mr. Rajendra.
Yeah.
PPT was made, sir. Can you just go to PPT because it's showing the desktop screen? No, PPT, sir. Now I'm seeing your mail page.
It enough, please.
No, so I'm seeing your desktop screen. PPT is not visible.
1 second.
Just stop it and reopen PPT because you're seeing the blank screen there. Yeah, that too. Yeah, now it's visible, sir. Yes, sir.
Okay.
Thank you. Ma'am, you can.
Yeah. Okay. So, good afternoon, sir. Rajendra Prasad, sir, Chartered Accountant, who's joined us today to speak on the inbound and outbound investments and structuring and the FEMA and international tax perspective. At the outset, sir, a very happy New Year to you on behalf
Thank you.
of SIRC and all the members who have joined in today. And thank you very, very much for accepting our invitation to share your knowledge with us on FEMA, which is something which is impacting us on a day-to-day basis and which is also so dynamic, and the consequences of any, even the minor transgressions are, the impact is very huge. So thank you so much for accepting our invitation. A brief introduction of CA PVR Rajendra Prasad. He's a fellow of our institute, and he has had a brilliant academic career and is a rank holder in the final examination. He has over 35 years of professional experience and is the founder and CEO of PNP Consulting Private Limited, which is an international forex and business consulting firm having offices at Hyderabad, Dubai, Singapore, and specializes in foreign investment consulting, foreign exchange regulations, and cross-border mergers and acquisitions. He is a founder and managing director of JBR Capital Private Limited, a Category 1 SEBI-registered merchant bank, and he's the advisor of several MNC clients in India and abroad on structuring of inbound investments into India and structuring of outbound investments. He has contributed many papers and delivered lectures on the subject of foreign exchange regulations of India and international finance at various forums in India and abroad, including the ICAI, the Institute of Company Secretaries, Institute of Cost Accountants of India, and also the Nalsar University and Singapore government programs. So over to you, sir, and thank you once again for your generosity in accepting to share your knowledge with us. There are more than 600 chartered accountants eagerly waiting to hear you on this topic.
Yeah, thank you very much, madam. Thank you, Revati, madam. Thanks a lot for the generous introduction. And Sri CA Pramod Jain, Chairman of the Committee of International Taxation, CA Jalapati, Chairman of SIRC, and other distinguished speakers, and also erudite participants. All of you, very good morning, and thanks a lot for giving me this opportunity to be with all of you today morning on this slightly complicated subject, Foreign Exchange Management Act. So before the concept and the paper, what they have given me is to dwell upon on the inbound and outbound structuring, which will be important when you are making any international taxation advice or you are trying to plan an international tax issue. So before I go into the subject, I just want to, I think my slide is visible. Yes. So I just want to tell three things before we get into the subject. The first and foremost thing is a popular view that has been propagated is Foreign Exchange Management Act has now become like any other commercial law. and it was not like what it was as an earlier FERA, but slowly and steadily, Foreign Exchange Management Act is being brought from commercial law to criminal law. They have brought in slowly one after another all criminal provisions into it. So that we have to keep it in the back of mind while we are doing any cross-border transaction, that this law is a criminal law. Number two, I take the liberty, since I am also a chartered accountant, I am taking a liberty of telling all of us that we chartered accountants have somehow, tax has gone into our DNA. So as a chartered accountant, we start visualizing everything and interpreting everything as how we do it in an income tax legislation. But my humble submission to all the erudite participants here is that as far as FEMA and money laundering are concerned, these should not be interpreted like income tax. These are the legislations where the regulator and the government is having absolute prerogatives. So we should not rather get into a concept of trying to explain a transaction why you have conducted like that, because unfortunately in this law we don't have any redressal mechanism. The redressal mechanism only comes in after the enforcement directorate initiates a case. So in the backdrop of this, we need to be more careful while going through the legislation and also while going through the notifications issued under the law. And the third point which I want to bring it to your notice, which you all may be knowing, what is logical need not be legal. So what is legal need not be logical. So if we are trying to bring something and argue why it is not this, why there is no logic here, unfortunately, it will be a waste of time and exercise trying to find the logic in the law. Just I thought of these 3 points, I'll put it before you as a preamble, and then we'll get into the presentation. I think today I am going to make a presentation on inbound investments as well as outbound investments. As far as inbound investments are concerned, we'll straightly touch upon some of the basic policy framework and some of the regulations related to inbound investments and downstream investments and what are the emerging issues. And there is a very, very heated debate and discussions on round tripping issues. Those things also we'll discuss. And as far as outbound investments are concerned, we'll see what is the policy framework and what is the automatic route conditions, and how raising of funds using outbound investments can be done and what cannot be done, and what are the regulations with respect to disinvestments. And finally, the most important thing, if individuals are making investments abroad in companies, what are all the issues which we have to keep it in mind. So we'll go into the inbound investments. The overview of the legislation is something like this, where we have FDI policy, we have press notes issued by Department, this Ministry of Commerce and Industry, and press releases are issued by RBI. There is a FEMA Bear Act, which is a small legislation having only 49 sections. FEMA rules are there, and FEMA notifications are, some were issued by Reserve Bank of India, and some notifications now are being issued by Ministry of Finance. There are APDR, there's authorized person directions issued by Reserve Bank of India, and master directions. This is the whole gamut of the FEMA regulations. But my submission to you is, if you are finding something in a press release, please just simply do not take a decision based on the press release. You need to look at all the relevant regulations before taking a call, whether a particular action can be conducted or whether a particular investment can be made or not. An overall view has to be taken, not simply based on one press release or one circular. And next is the applicability of the Act. The Act applies to whole of India. It applies to branches, offices, agencies outside India owned or controlled by a person resident in India, and any contravention thereunder committed outside India by any person. But let us get into this in a little bit more clarity, sir. This Act wants to control, have its jurisdiction outside India. If there is a branch or office or agency outside India, which is either owned or controlled by a person resident in India, then this FEMA applies there also. in view of this, in our next next slide, we'll be seeing an important concept under the policy framework, that is person resident in India under FEMA, wherein these branches, offices which are outside India, owned or controlled by person resident in India, is treated as a person resident in India. So this is one legal fiction which was there in FERA Act has been removed under FEMA. So under FERA Old Act, a branch outside India was treated as a person resident outside India, but under FEMA, a branch or office or agency is treated as person resident in India. And this is something very, very important which you have to keep it in mind while especially trying to design an international tax structure. And now let us come into the definition of person resident in India, which is definitely slightly divergent with the income tax person resident in India definition. Here, what it states is a person will be treated as a person resident in India who has resided for more than 182 days in the preceding financial year, but does not include who has gone out for employment, business or occasion, or with an intention to stay outside India for an uncertain period. And there is one more clause, but does not include who has come to India otherwise than for employment or business or occasion, or with an intention to stay in India for an uncertain period. And as usual, Reserve Bank of India has made it very clear that Reserve Bank of India will not determine the residential status. It has to be, the definition has to be understood by the constituent who is conducting a transaction, and he has to make himself clear whether he is a person resident in India or person resident outside India. Basing on that, he has to conduct his transactions in compliance with the regulations and the extant guidelines issued by Reserve Bank of India through FEMA as well as by the central government. So it is clearly very clear that the onus is on the person who is trying to conduct a transaction. He has to prove his or her residential status. So now, where can we get some sort of a conclusive proof that whether a person is resident in India or not? I would suggest if any person is opening a non-resident account, that is non-resident ordinary account or non-resident external account, then an authorized dealer is exercising his judgment in opening an account. That will be one conclusive proof whether a person is resident in India or outside India. So that becomes very, very important. If any person has gone outside India, it is better to open this non-resident accounts as quickly as possible. And also, if any person is coming back into India, it is better to close such type of accounts and intimate the authorized dealer that he has become a person resident in India. And the definition still continues: any person or body corporate registered or incorporated in India, office, branch or agency in India owned or controlled by a person resident outside India, office, branch or agency outside India owned or controlled by a person resident in India. As we just discussed earlier, the same thing, a branch or agency outside India which is owned by a person resident in India is also treated as person resident in India. So because of this, if a company in India wants to open a branch outside India, for opening the branch, no permission is required because you are still treated as person resident outside India. But after opening the branch, if the branch outside India wants to open a bank account or wants to conduct some transactions there, then there are regulations controlling them. But whereas under earlier FERA, even to open a branch, a permission has to be taken by Reserve Bank of India because opening a branch was considered as a person resident outside India. Though this change has come, but in practice, if we see, if you go to an authorized dealer tomorrow and say, my company wants to open a branch in London, he will give you the same old FERA form and he will ask you to fill up that form and give it to him. And then he will try to give a permission. This is more done by authorized dealers to have a control on the transactions happening, but not based on the law what has been enacted. But having said that, since opening alone is not, permission is not required, rest of the things, all permissions are required. This has to be kept in view whenever there is a outbound investment structure is designed. one important thing that has to be kept in the back of the mind is, if it is a branch you are opening outside India, even though you are having tax advantages by opening a branch, as far as that branch is concerned, that will become a person resident in India. So if it becomes a person resident in India, all FEMA regulations what are applicable to a person resident in India will also apply to the branch. So this has to be kept in view while making any structuring with respect to international taxation. Then another important point, which is the point which merits our lot of attention, is a capital account transaction. The whole of this law has been divided into two parts: capital account transactions and current account transactions. This is one concept they have brought in through FEMA to make it very clear how to control and what is the controlling mechanism to bring in place. For that, they have defined what is a capital account transaction, and they have also defined what is a current account transaction. This understanding of capital account transaction is very, very important, because the whole law and the control monitoring by Reserve Bank of India or Government of India is aimed towards these capital account transactions mostly, and some of the current account transactions are also controlled. Let us first understand what is this capital account transaction. A capital account transaction, as defined by the law, is a transaction that alters assets, liabilities, contingent liabilities outside India of a person resident in India. So if a person resident in India is conducting a transaction, by virtue of the transaction, if the assets, liabilities or contingent liabilities outside India are getting altered, either going up or coming down, such type of a transaction is a capital account transaction. This is with respect to a person resident in India. With respect to a person resident outside India, if he is conducting a transaction in India, if assets and liabilities are getting altered, then it will be a capital account transaction. But if you observe here very carefully, the contingent liabilities in India getting altered for a person resident outside India is not treated as a capital account transaction. So I will just give one small example before we get into the other important points. Suppose a company in India has imported a $10 million machinery. From our accounting aspect as well as tax aspect, we treat that as a capital asset. But under FEMA, it is a current account transaction, provided by virtue of import, if that import is settled in, import dues are settled in 180 days, and if there is any export made, that export realizations are received within 270 days, that will not be treated as a capital account transaction. Because I'll just try to explain it further, because this is a very, very important concept which we need to have a thorough understanding. Then the whole law will come into our grip. A capital account, suppose a person is importing machinery. So immediately he may be either opening an LC or he may be sending an advance. When he sends an advance money to the supplier outside India, then his asset outside India is getting altered. Because his asset is getting altered, that will become a capital account transaction. Or if he is opening an LC outside India on the supplier, his contingent liability outside India is getting altered, then also it will become a capital account transaction. So for the law has taken a view with respect to imports for trade, with respect to exports as a trade. For these two items, they have put some time limit, where in respect of imports, 180 days, basing on the economic situation of the country and your forex reserves, these are the dates they are finalizing. So as far presently for imports, they have put 180 days, exports they have put 270 days. If these are the dates within which the trade transaction is getting completed, that will not be treated as a capital account transaction. That is the only exception they have here. Suppose I am importing equipment with a credit period of more than 2 years, that will immediately become a capital account transaction, because my liability to pay that is crossing 180 days. Likewise, if I'm exporting something with and giving a credit limit more than 270 days, that also becomes a capital account transaction. So what is that happens if it becomes a capital account transaction? If it becomes a capital account transaction, then Reserve Bank of India and the Ministry of Finance, they can either regulate, prohibit, restrict, and do so many issues with respect to capital account transactions. Because as we all know, we have not yet become capital account convertible. That is the reason why the controls are exercised these capital account regulations. So for that, it becomes very important for us to understand whether it is a capital account transaction or not. And if it is not a capital account transaction, the law has defined it as a current account transaction. Now for current account transaction also, the law has made it very clear that if a non-resident is having a current account transaction in India, such current account transaction are not having any restrictions. The only restriction is whatever is the tax dues he has to pay, and he can take it back outside India without any limit. As far as the residents are concerned, if we are conducting current account transaction, they have given only for certain items restrictions, wherein more than that, if we want to send some money, like one example, they have put it as a liberalized remittance scheme. Within that, they subsumed all these current account transactions. They said if you want to give a gift to somebody outside India, then you cannot give more than 250,000 USD per year. Likewise, suppose you want to import something subject to DGFT and foreign trade law, you can import, there is no restriction on the amount. But if you want to send some amount as a maintenance charges to your family staying outside India, then they have put under subsumed under the LR scheme. Likewise, they put some controls for residents. As far as non-resident, there are no controls given subject to payment of taxes. The amounts can be repatriated outside India. So the whole policy framework and what we are going to discuss about the inbound investment or outbound investment are all capital account transactions which are now regulated. Some they have permitted, some they have restricted, and some they have prohibited. Those things we'll try to discuss as we get into inbound investments. Before we go into the inbound investment, there is one section which is extremely dangerous and which we need to have a clear understanding of it. That is section 3. This section deals, section 3A is dealing in foreign exchange and securities not through authorized dealer. But to put it in a blunt language, section 3A means hawala transaction or sending or receiving money not through proper authorized banking channels. If the monies are coming or securities are sold or received through a hawala route, section 3A comes into picture. Section 3A gives the power to the enforcement directorate to seize everything, and also they have made it very clear such a type of section 3A contraventions cannot be compounded by Reserve Bank of India, and the CA section 3A has to be only dealt by enforcement directorate. There is another section, section 3B, making payments to or for the credit of any person resident outside India in any manner unless permitted by the Act or rules of Reserve Bank of India. Such type of payments or such type of giving credit is controlled and regulated and restricted by section 3B, and section 3C is any forex receipt without any corresponding inward remittance, and section 3D is a financial transaction in India with a corresponding creation of asset or credit outside India. I think, my dear friends, I want to tell you section 3 alone, then most of the case law is around section 3 only, as far as FEMA, even the corresponding section to that under FERA, the same section had all the complications connected with that, and I strongly suggest that you have a very thorough reading on section 3 the case law before you conduct any international structuring or tax advisory. Section 3 has to be taken read very closely. Then we'll put an end to this policy framework presentation. Finally, to sum it up, when this FEMA applicability will trigger, a transaction between a person resident in India and a person resident outside India, whether FEMA will come into picture? Yes. Transaction by non-resident in rupees? Yes. Transaction by resident in foreign currency, yes. Transaction by non-resident in India, yes. Transaction by resident outside India, yes. Then what are the transactions which are the outside the ambit of FEMA? Are only transactions outside India between non-residents in foreign exchange without any connection to India. I just want to tell one small example before we get into inbound investments. A general mistake committed where several cases have been handled in at least Mumbai as well as Hyderabad, the enforcement directorate is the resident properties in India purchased and sold between non-residents outside India. So some non-resident A owning a property in India and selling that property to another non-resident B, but the transactions happening outside India, transactions I mean the money physically not coming into India, flowing out of India, settling outside India, but tax payments are made in India, will be a contravention in India. As per the law, if any non-resident is selling property, the money has to come to India and money has to be realized even though he is selling it to a non-resident. That means the non-resident buyer has to send money into India and the non-resident seller has to receive that money in India. And if he is eligible to repatriate it, he can repatriate it. But this cannot be settled outside India. So these FEMA trigger points have to be kept in view where it is applicable. If it is applicable, then we have to look into what are all the provisions and regulations applicable for that particular transaction, and then only we have to conduct. Friends, then let us get into inbound investment regulations. So as we have already discussed, if any person resident outside India is investing in a company, then his asset in India is getting altered. Because his asset is getting altered, that is a capital account transaction. Such capital account transaction is controlled, regulated through inbound investment regulations, earlier through a notification number called FEMA 20, where Reserve Bank of India used to issue that notifications. Later, sometime in 2019, I think the government has taken a decision as far as foreign inbound investment regulations are concerned. They will be regulated by Ministry of Finance, and they have removed that from Reserve Bank of India. And now there is a Ministry of Finance is issuing rules, and such the foreign exchange management non-debt instrument rules are rules issued by the central government. But more or less these rules are almost, you can say, they are cut and paste copy. What RBI earlier has issued has now been issued by the Government of India through Ministry of Finance. In these, let us try to discuss some of the important concepts in these inbound investments, which may be of some use to you when you are structuring any international tax advisory for a non-resident investing into India. What investments he can make, what are and which, who is an eligible person in India who can accept such type of investment. We'll just go through it. But primarily, as per this foreign exchange management non-debt instruments regulations, this is no person resident outside India is permitted to make any investment in India. This is the preamble to the regulations. And no person resident outside in India is permitted to receive any investment from person resident outside India unless it is specifically permitted in the FEMA or rules made thereunder. So this, what makes this very, very important is they have put a blanket ban. Having put that blanket ban, they started giving permissions one by one. So if there is no specific permission mentioned anywhere in the regulations, that means this prohibition comes into operation. So here what I would like to bring it to your notice is, because that is not mentioned, we do not have the luxury of assuming it that it would have been there. No. The moment a particular mention is not there with respect to acceptance of investment by a non-resident Indian, unless it is specifically mentioned there, this prohibition will come into operation. So this should become the first fundamental rule while getting into inbound investment. Then a lot of things will become easier. Next, then what are the permitted investments? Investments permitted by non-resident India can broadly be categorized into two parts. One is investment with repatriation and investment without repatriation. Repatriation, what the law is envisaging here, is only with respect to capital. As we have discussed earlier, for current account transactions, non-residents, there are no restrictions with respect to current account transactions. I'll just try to explain with one small example that may make it a bit more clear. If suppose a person resident in India had acquired an ancestral property which is giving a monthly rent of 10 crores, for example, and later this person has become a non-resident and he is continuing as a non-resident outside India, but he is still getting that rent of 10 crores per month. Because he has become a non-resident, his income in India, which is a current account transaction, after payment of taxes, without any limit, the money can be repatriated by him outside India if he so requires. If he wants to park that in India, he can, but if he wants to take it outside India, he can take it outside India. That means the income is not controlled, only the capital is controlled. When we are discussing about repatriation, we are only talking about the capital, what is not permitted to be repatriated, what is permitted to be repatriated. They broadly divided into two sections. One is with repatriation and another is without repatriation of capital. As we discussed earlier, income is always permitted to be repatriated after payment of taxes. Now let us first look at without repatriation, then we'll go to with repatriation. Without repatriation, investments can only be made by non-resident Indian individuals and an overseas citizen of India. Other foreign citizens of foreign origin are not permitted to make without repatriation investments unless they take a specific approval from the central government through Reserve Bank of India. And apart from these NRIs and OCIs, recently in the years of 2016 or 17, they also allowed entities which are registered outside India, which are owned or and controlled by NRIs, OCIs, also can make investment without repatriation benefits. So these type of entities earlier when FEMA came into picture was called as OCBs, overseas corporate bodies. But because of this Ketan Parekh scam in the year 2002, from 2003, there was a joint parliamentary committee probe, and they prohibited any overseas corporate bodies investments into India. At that time, overseas corporate body was defined as NRIs or persons of Indian origin holding more than 60% equity or control on such type of entities, but they were stopped, and from 2003 they were not permitted any entities investing. Now in the year 2016 they started again any entity outside India which are owned and controlled. Owned and controlled is obviously owning more than 50% and more than 50% management in the hands of NRIs or overseas citizens of India. Such type of entities can make investments in India. And what is the advantage of investing under without repatriation is the capital cannot be repatriated outside India. That is a disadvantage. But the advantage is such investment will be treated on par with the domestic investment, and all the restrictions what are there will not apply to such type of investment. What a person resident in India is permitted to invest, the same thing will apply to the investments made by NRIs, OCIs, or entities which are owned and controlled by NRI, OCIs can make investment without repatriation. But if suppose let's say Microsoft wants to invest in India under non-repatriation, that is not permitted under automatic rule, and that requires a prior specific government approval. Likewise, another example here we can give is if there is a partnership firm in India, the investments can only be made by NRIs or OCIs or entities outside India owned or controlled by them, but not by foreign companies of foreign origin, which are not coming into the definition of entities owned by NRIs or OCIs. Then the whole law is revolving around investments with repatriation benefits. And who are the eligible investors and what are the eligible investments? That is what now we are going to discuss in all our next slides. But let us also first look into, without repatriation, what are all the conditions they have put. Eligible investors are, as we discussed, NRIs, that is non-resident Indian, that is an Indian passport holder staying outside India, and overseas citizen of India is a foreign citizen holding an overseas citizen of India card by virtue of his origin being from India and holding that OCI card. Then only he will become an eligible investor, and a company, partnership firm, and a trust incorporated outside India and owned and controlled by NRIs, OCIs are permitted to invest. The eligible investments are equity shares, convertible preference shares, convertible debentures, warrants of any company without any limit, either on stock exchange or outside of it, units of an investment vehicle either on stock exchange or outside, capital of an LLP, proprietorship or partnership firm. There are certain prohibited investment. Even though these are the investment treated on par domestic investment, there were some specific prohibitions they have brought in. That is, the investments cannot be in Nidhi company. Investments in any entity engaged in agriculture plantation activities not permitted. Construction of farmhouses not permitted. Dealing in transfer of development rights not permitted. And investment in real estate business not permitted. Real estate business is what, according to FEMA, their definition is, if the investment is made in business, means without any development or without any superstructure built up or without making the land more developed than what it was, and just conducting a speculative transactions of buying and selling is treated as real estate business. Such real estate business is akin to real estate trading without any value addition, is a prohibited investment. And capital invested cannot be repatriated outside India. But for this also there is one small exception. NRI individual and OCI individual who is investing in India, though he is not permitted to transfer any capital outside India, he can still repatriate up to $1 million, provided he is getting as a legal and bona fide money is coming into his NRO account, he can still repatriate. This is one good planning area available, where the investment is made in a partnership firm under non-repatriation basis, and partner retires and capital comes back into his NRO account. From that NRO account, per financial year, he can send up to $1 million. This also can be kept in view. These provisions are there in the Foreign Exchange Management Remittance of Assets Guidelines. Now let us look at the investments by non-residents with the repatriation benefits. These are broadly divided into automatic route and government. Automatic route means there is nothing automatic there. What RBI wants is, they have given a set of guidelines, and all those guidelines have to be carefully read, understood. You apply and conduct a transaction. Then you do the regulatory filings to the Reserve Bank of India through authorized dealer. If they find out that something is not complied with, they come out and levy penalty either through compounding mechanism or by investigation by Enforcement Directorate. Their concept of automatic route is, earlier we need to go to RBI to take a permission. That is not required now. But still that entire concept of compliance is put on the person who is conducting this transaction to go through. If the automatic route guidelines, that is in the Foreign Exchange Management non-debt instrument rules, if that has been specifically mentioned that automatic route is not permitted, then it has to go for a government route. That is, an application has to be made to the central government for giving an approval. That also we will see. First, let us get into this automatic route. What are the entry routes and sector-specific guidelines and pricing guidelines? And there are some very important definitions they have given. Just we'll try to understand and quickly go through those definitions for us to have a clarity on them. Indian entity means an Indian company or a limited liability partnership. Indian company means a company incorporated in India. And foreign investment means only such investment which has been invested on repatriable basis in equity instruments of an Indian company or to the capital of LLP only will be treated as foreign investment. Person resident outside India holding beneficial interest in resident entity shall be construed as foreign investment, even though the investment is made by resident Indian citizen. This is one exception they have given, where because as per our Companies Act, it requires 2 persons to hold the shares in case of a company which is a private limited company, not a single person company. Then such shares, if they are held by an Indian resident on behalf of a foreign investor, that also will be construed as a foreign investment but will not be treated as domestic investment. Then another important point which I would like to bring to your notice is the foreign direct investment. The definition of it has undergone the change, and this is very, very important with respect to listed companies, especially. This foreign direct FDI policy first defined FDI as an investment made by persons resident outside India under Schedule 1 of FEMA 20. Then on 7th November 2017, the definition of FDI changed. 10% holding concept came into effect based on the report of Dr. Arvind Mayaran Committee on Rationalization of FDI. Person resident outside India can hold investment either in FDI or FDI. I will try to just give stuff, just telling that what they try to call is what is FDI and what is foreign portfolio investment is a debate going on from long time. What is FDI and what is FPI is only relevant with respect of a listed company. In respect of unlisted company, any investment made by non-resident under repatriation basis will become a foreign direct investment. But with respect to a listed company, if a person is buying stock in the stock exchange, and if he is buying, let us say 20, that without getting into takeover code, if he is buying 13% of the stake of the company, whether that should be treated as FDI or whether that should be treated as FPI is a discussion going on for a long time. And then they have finally, the central government has appointed Dr. Arvind Mayaran as chairman of a committee set up to look into this rationalization of definition of FDI, and he has come out through his report. He said that investment through equity investments in an unlisted company is FDI, but if it is more than 10% in the equity investments of a post-issue paid-up capital on a fully diluted basis of a listed company will only become FDI. Otherwise, it will become a foreign portfolio investment. This appears to be simple, but when you start getting into the practical application of it, it becomes much more complicated. Like if a listed company wants to allot fresh issue of shares to non-resident Indians under preferential allotment by just by 3% or 2%, then that will not be construed as FDI. If it is not construed as FDI, then that is not permitted to be issued under automatic rule. So this is one very important point you have to keep it in mind. If you are structuring anything connected with listed companies, in case of unlisted companies, any investment, even one share issued, will be construed as FDI, provided it is issued under repatriation basis. And the foreign portfolio investment means any investment made by foreign person resident outside India through equity investment, where such investment is less than 10% of the post-issue paid-up capital on fully diluted basis of a listed company. Less than 10% of the paid-up each series of instrument issued by the company, and foreign portfolio investment can be made only by PRO. And the two groups, person resident outside India, who are registered as FPI investors and who are other than FPI investor. But most important point which I would like to bring it is a foreign investor who is investing in a listed company can either be an FPI investor or FDI investor. He cannot be both. This is one thing which they have brought through the foreign exchange management non-debt instrument regulation. Prior to that also in FEMA 20 it was there, and which has been solidified now. And this is one concept which has to be kept in view, especially when you are structuring an inbound investment transaction, which is having an acquisition of the existing stake. So whether you want to bring him as an FPI or you have to bring him as an FDI is a concept that has to be well understood and taken into consideration while you are making the structure. And now let us look at what are the equity instruments that can be issued by an Indian company to a non-resident who is going to invest under repatriation basis. Only these are the instruments permitted: either equity shares, fully compulsorily mandatorily convertible debentures, fully compulsorily mandatorily convertible preference shares are the three basic instruments permitted. Any other exotic instrument requires prior approval from Reserve Bank of India, but only these plain vanilla equity shares, CCDs, compulsorily convertible debentures, compulsorily convertible preference shares are only permitted. And they also permitted partly paid shares which are issued under Companies Act 13. 25% should be upfront and balance has to come within 12 months. And share warrants only by equity listed companies, 25% upfront and balance within 18 months. So this one, please make a note of it. The share warrants can only be issued by equity listed companies. Earlier, some private limited companies also tried to use this mechanism, but now the FEMA regulations, especially this non-debt instrument rules, made it very clear it has to be only by the listed companies. Optionality clause permitted with 1 year lock-in period or as specified by sectoral guidelines, whichever is higher and without any issued return. Sir, this concept also I want to explain. Generally, when you are structuring any inbound investment, the investor wants some sort of an assurance, which generally any investor will ask, and the company which is in need of equity or which is in need of funds to come into the company may be agreeable to give him some sort of an assured return, but such type of giving any assured return is prohibited as per FEMA. Only they have given optionality clause, that is you can extend, maximum extent we can go in the contract is we can tell, that is I am talking about we in the sense the Indian company can give an offer to the foreign investor that after 1 year lock-in period we will buy back, but buy back at the rate as per the valuation done on the date of sale, but not by giving any assured return, that giving so much return will be given by any way of exotic thing will become a contravention. And optionally, partially non-convertible preference shares were issued earlier and were done till 2007. All those things were stopped from 2007 April 30th, though will be concluded as capital instrument till their maturity. And subsequent issues of similar instruments will be treated as ECBs. Suppose if we are not giving this plain vanilla, fully convertible, mandatory convertible debentures, suppose we are telling optionality clause is there, or we are putting any other exotic nature, like in the event of EBITDA coming down or going up, they have a right to create, increase the number of percentage of shares or decrease the percentage of shares. All these things, if they are issued without taking specific prior approval, which I think, according to my personal opinion, they will not give any permission. If they give without permission, if it is done, that will be construed as a loan taken, not as equity, and all ECB guidelines, which are external commercial borrowing guidelines, will apply. Optionally, partially, and non-convertible debentures issued up to and as on June 7, 2007 only will be construed as capital instrument till their maturity. All others will be treated as ECBs. And also there is another important concept which you will be reading if you are getting through this FDA, foreign non-debt instrument regulations, earlier inbound investment regulations, is a concept called FDI linked performance conditions. Reserve Bank of India and the Government of India have not defined. When they have not defined, the life was peaceful. When they started defining it, nobody is able to understand. Sometimes the definitions given by RBI are not, because they make the point non-understandable. So here they said sector specific conditions specified in Schedule 1 of non-debt investment rules, instrument rules 2019 for companies receiving foreign investment, FDI linked performance company phase was there. So what they want to say is, if there is earlier, or instead of complicating, let me just put it earlier, they said if any FDI linked performance conditions are there, then there are some other set of guidelines. What are those? The popular belief was there were some investment guidelines given to some sectors, like in real estate sector. Earlier in the real estate sector, they have put that the minimum investment has to be so much, and the maximum investment has to be, the minimum area of development has to be so much. Like that used to be there, and also for NBFC used to be there. But now, what they are telling is the FDI linked performance conditions means if you go to non-debt instrument rules, against the sector specific guidelines, if there are any conditions given there, those are FDI linked performance conditions. So if you look at all the sector specific guidelines, for every sector there are some conditions, except one or two like manufacturing and one or maximum two. All other sectors are having some or one condition. So if there are some conditions, what is the problem? The problem is with respect to limited liability partnership firms, foreign investment can be accepted under under repatriation basis, provided it is in a sector where there are no FDI linked performance conditions. So if the FDI linked performance conditions are there, then we cannot access automatic route. We need to take a prior permission. This is one concept you have to keep it in mind while structuring any investments coming into LLPs especially. Then we'll quickly go through who can invest in India, a person resident outside India or an entity incorporated outside India. But obviously, it cannot be, I mean, recently after this corona, as COVID has come in, they passed a law that an entity of a country which shares land border with India or where the beneficial owner of an investment into India is situated in or is a citizen of any such country can invest only under the government rule. Very, very important, sir. You have to keep it in mind. If there is a company in London is investing, but the beneficial owner of that London company is, let us say in our example, a Chinese citizen, then you cannot access automatic route. This point needs to be very carefully taken into consideration. Next, obviously, we know this Pakistan, citizen of Pakistan or any entity incorporated in Pakistan can invest only under government approval route, and in sectors other than defense, space, atomic energy, all prohibited sectors, Pakistanis were not allowed. And even in the sectors they allowed, you need to have prior approval of government. And in the event of transfer of ownership of any existing or future FDI in an entity in India, directly or indirectly, resulting in the beneficial ownership falling within the restriction purview of the above restriction, such subsequent change in benefit will require also government approval. Any sort of plannings we make, where at the third layer, fourth layer also, if there is a change happening and that change is making some land border country citizen or entity becoming a shareholder, that is also not permitted. And that requires prior approval from the government of India. We cannot access automatic route. And overseas corporate bodies, which we discussed, they have been done away with from 16 September 2003. But as I told, from 15 to 2016, again, they were permitted. And foreign portfolio investors who are registered with SEBI and foreign venture capital investors registered with SEBI, these are the only people permitted to invest in India. Who can receive foreign investment? Companies, LLPs, investment vehicles registered through SEBI like alternative investment funds and other vehicles which are permitted by SEBI to be registered, partnership firms, proprietorship concerns, association of persons only in respect of oil and gas sector, SEBI registered venture capital trust are permitted to receive foreign investment. Apart from the above, foreign investment is not allowed in any other entity. We already discussed what is foreign investment. So that is not permitted in respect of other entities. And what are the Indian company may issue equity instruments to person resident outside subject to sector specific regulations. There are 17 sector specific guidelines and issued in addition to financial services sector. And financial services sector, I strongly request all of you to get into that financial service sector guidelines. They are very, very important because they are telling any entity which is into financial service sector, if it is not regulated by a regulator, then such a type of a financial service sector requires prior approval from Government of India. And also they made it very clear that if one is not clear whether such sector is a financial service sector or not, even then it has to go and take permission from the central government. They cannot take a suo motu decision that it is not financial service sector. That is what has been mentioned there. So I strongly request all of you to go and very keenly go through that financial service sector guidelines issued in the sector specific guideline. And they have given some small benefit that WOS set up by a non-resident entity can issue equity instruments against pre-incorporation expenses or pre-operative expenses up to a limit of 5% of the capital or USD $500,000, $500,000, whichever is less. That is, for that, other than this, if you want to allot shares without money flowing into the country by making an adjustment that some amount has been already incurred by that foreign party, in lieu of that we are giving share, that requires government approval. But only this is one exception they have given, and sector where 100% FDI allowed under automatic route and there are no FDI linked performance conditions, then only this above exception is available. These are very, if you start putting logic in here, we will be missing, searching for logic only. It is better to go and try to understand the law and try to implement that law. That will be much safer. And also I would like to put it before your these erudite participants that Enforcement Directorate and Reserve Bank of India have become extremely aggressive with respect to levying penalties in India, especially from last 3 to 4 years. In view of that, these things become more important because the penalties are becoming so big, then the business model itself is collapsing by virtue of paying these penalties, and it is better all these things are addressed, discussed, debated before an investment decision is taken. So the other issues that are important are Indian company may issue equity instruments person resident outside India if it is engaged in automatic route sector against swap of capital instrument. This is one very, very important concept which you will be using in your international tax structuring. The swap of capital instruments is an Indian company allotting shares to non-resident companies shareholders to acquire the shares of the non-resident company, and non-resident shareholders will become the shareholders of the Indian company. This swap mechanism is permitted without taking the permission of the central government, both for the legs, inward leg as well as outward leg. But only thing is all outbound investment guidelines have to be complied, all inbound investment guidelines have to be complied, then only the swap of capital instruments is permitted. And import of capital goods, machinery, equipment, excluding second-hand machinery, yes, in lieu of that, the shares can be allotted. And pre-operative, pre-incorporation expenses, which we have discussed earlier, the same shares can be allotted. One more benefit what they have brought in is, if there are any payables which either permitted through general permission, that is, there are current account transactions which are in compliance with the FEMA guidelines, like if suppose a company has imported certain material or imported certain services and such services are not yet paid and the amounts are due less than 180 days, such type of things can be converted into equity. If there are any non-compliances, then the equity can only be issued after all those non-compliances are regularized and if the compounding proceedings are initiated after completion of compounding proceedings. Like one example, if there is an import and the payment is not made within 180 days, but it is taking more than 180 days, or there are other non-compliances with respect to the transaction, then shares cannot be allotted under automatic route. Only after regularization of it can be allotted. And government route, what is foreign investment in investing companies not registered as NBFC with the RBI and in CICs both engaged in the activity of investing in capital of other entities require prior government approval with effect from 26/3/2018. This is one concept I think I want to bring it to your notice. If there is a company set up in India with the intention of investing in other companies, and such company is not registered as NBFC or not as an CIC with RBI, then any equity coming into that company requires prior approval from government. And where the person resident in India specifies who has made foreign investment, a particular audit firm having international network for the audit of the Indian investee company, then the audit should be carried out as a joint audit, wherein one of the auditors should not be the part of the same network. This is one rule they brought in through FEMA. If the foreign investor is investing in India and they want to make one particular audit firm which is having some international network, then there has to be a domestic auditor who has to be a joint venture auditor. So that is what the rule that has been brought in through FEMA. And pricing guidelines, which are very important for all of us. The listed company shares should be as per SEBI guidelines, and unlisted company, listed company as well as company under delisting process as per SEBI guidelines. Unlisted company shares, any internationally accepted method on arm's length basis, valuation has to be done by a chartered accountant or a merchant banker or a practicing cost accountant. Here the point I want to bring it to your notice is, under Companies Act, the chartered accountant who is a registered valuer only is permitted. As far as FEMA is concerned, valuation is only by CA or a merchant banker or a practicing cost accountant as on today. Still this is continued. And if the price conversion formula for convertible instruments and share warrants should be decided upfront at the time of issue, price conversion should not in any case be lower than the value converted out. Sir, this point also I want to bring it to your notice. If any company is planning to issue compulsorily convertible debentures or preference shares, the valuation of shares have to be done upfront, not on the date of the conversion. They have, the value has to be decided upfront at the time of issue, and the company allotting such CCDs or CCPS to foreign investors, the company has to tell how many shares it will become at the time of conversion. So that means the amount at which the share is going to be converted has to be decided upfront, and that percentage and number of shares have to be mentioned to the Reserve Bank of India. The percentage or number of shares can be reduced, but it cannot be increased. Otherwise, what they are trying to say is the value can be reduced, but value cannot go up. But as a practical side, from my side, my suggestion is you should upfront decide, and the same rate has to be fixed. Otherwise, even if you increase or decrease, that becomes a point for enforcement directorate to make an investigation, which has happened in several cases earlier. Investment by non-residents by way of subscription to memorandum may be made at face value, and any swap of shares has to be done at valuation as done by merchant banker in India or an investment banker outside India. Just quickly before we go into outbound investment, let us also understand these downstream investments. This is one area which requires your little bit of attention. The downstream investments is a concept called operating income holding company, which I am talking about in 2009. Prior to 2009 and wherein this press note 234 has come. If suppose a company in India which is owned or controlled by a foreign company, such a company is making investment in another Indian company, we tend to think that since it is an Indian company making investment in another Indian company, there will not be any impact of foreign exchange management, especially with respect to inbound investment regulations. But that concept was not agreed by the government. The government earlier in 2009 used to say, if there is any Indian company which is owned or controlled by a foreign company, if it is making investment in some other Indian company, then it has to get government permission till 2009, and that permission they popularly used to call changing of the concept of changing of the company's activity from operating to operating cum holding company. Anyway, that all has gone. The position has changed with the introduction of press note 234 and notified by Reserve Bank of India in 2013. government has taken a decision in 2009. Just we'll try to understand what is this concept. The concept is, if there is a foreign investment in an Indian company and such a foreign investment is owned more than 51%, or such foreign investment is controlling the company, what is the definition of control? Control as defined in Companies Act. That is, even though the foreign company is only owning 10%, but it is virtually controlling the board decisions, virtually controlling the investment decisions, virtually controlling the liquidation decisions, or having veto powers. All such type of control as defined in Companies Act. If such control are having ownership more than 51%, if such Indian company is making investment in another Indian company, then it has to comply with all the guidelines, whatever are mentioned earlier in the inbound guidelines. Inbound investment guidelines have to be complied. That is, we will take one small example. If a software company, 90% held by a foreign company, wants to invest in a company which is into real estate farmhouse development, whether it can do? No, it cannot do, because the inbound investment guidelines are telling any investment into real estate sector which is into farmhouse development is not permitted. So through your other Indian company also is not permitted. This concept is called downstream investments. They have that press note 234 issued in 2009, and later Reserve Bank of India accepted those press notes only in 2013. They brought it into law. Now the present non-debt instruments regulations are also having this too. That is, if there is an operating company or an operating LLP, it can make, that will be treated as a foreign investment. And if there is an operating cum investing company, earlier government permissions are all done away with. Under automatic route, it can make investment in another Indian company subject to complying with all the sectoral conditions, entry route, conditionality, sector specific guidelines. Though the investment is coming from one Indian company to another Indian company, it will be deemed as a foreign investment, and all compliances have to be complied with, except filing form called FCGPR. Here we have to file a form as a downstream investment form has to be filed, and there it has to be FCGPR has to be filed. But in case of an investing company or an LLP, as we discussed earlier, which is not doing any other activity except investing, that requires approval from Government of India. It cannot simply go and invest in an Indian company. That is what we discussed earlier. If a company has been set up in India by 4 or 5 foreign parties or one foreign company, and that company's objective is to invest in various Indian companies, then it cannot invest. It has to take prior approval of Government of India. But investment holding company without any operations and downstream investment, and they have made such type of company automatic route without from 15 September 2016, which makes a downstream investment or commences business, it has to comply. There are two issues different here. There is an investing company which is having some activities, but the interest is to invest in other companies. There is an investment holding company which is not doing any activity, and without doing any, just only they are bringing money and keeping it there. Such a type of companies, they have given automatic provision from 15th February. But if a company is doing some activities, but majority of it is only investing, then it has to take Government of India. They tried their best to confuse, but if you are jumping or bumping into a structure where it is only investing, you need to really take care, get into the FDI policy and go through that, then only you have to take a decision on that. And what are the emerging issues with respect to inbound investment? As we already discussed that Section 6.3, the Reserve Bank of India power has been removed and Section 6.2a has been inserted. But after having done that, again, they have given the administrative powers back to Reserve Bank of India on 27th July 2020. And only another important point that I brought in, which while in the beginning of my presentation I told, the law has become a criminal law, slowly changing from commercial law. This started happening from 9th September 2015. They brought in a new section called Section 37 capital A. That Section 37 capital A what it speaks about is any person is suspected to have held any foreign exchange, foreign security, or foreign immovable property in contravention of Section 4. Section 4 only deals with, gives you permission to hold assets outside India as permitted by Reserve Bank of India or by the guidelines issued thereunder. If anyone is suspected to have held, Department of Enforcement has power to confiscate equivalent value of domestic property in India. But you look at the dangerous portion of the law. Any person is suspected to have, they need not have any proof. By simply suspicion, the Enforcement Directorate has been given power to confiscate equivalent value of domestic property. And Section 13(1)(a) gives the power to impose penalty up to 3 times the transaction value. And Section 13(1)(b) gives them a power to file a criminal complaint, which will trigger the money laundering case. And Section 13(1)(c), in addition to above penalty, the imprisonment can be made up to 5 years and with fine. What I want to drive the point here is, and very high powers have been given to Enforcement Directorate. If such type of powers were given, then our structures should not appear to be in any way which are facilitating holding properties outside India in contravention of Section 4. This has to be kept in view whenever you are trying to decide, because suddenly they can come and start imposing the Section 4 contravention. The Section 4 contravention will lead to Section 37(a), and 37(a) gives them the absolute power. And another important point is, the Enforcement Directorate can say, I have a suspicion that so and so Mr. X is having property in America, and he will say, you disprove that you do not have. And friends, I am telling, disproving that a person is not having property outside India or within India is almost next to impossible. Because if somebody is telling you have that so and so particular property A, you prove or disprove, you can do prove or disprove. But somebody is telling you have some property, I do not know, I have suspicion, you disprove, and that becomes very, very difficult. So this is one section. The moral of the story is, we have to be good in our structure and planning. That is important. In addition to that, we should appear to be good also. That is also very, very important, which we have to keep it in mind. And another important issue which is taking a lot of discussion around is round tripping. Whether we have any regulations with respect to round tripping. As far as I know, there are no round tripping regulations. But if a capital is going out of India and coming back into India, this is popularly called as round tripping regulation. But to the best of my knowledge, I have seen such type of round tripping regulations only in Chinese law. But as far as India, they are still using it in a different format. Though it is very unregulated, ambiguous, it is still there in the different format. And also there are several regulations which have been decided by our Enforcement Directorate, special directors in their orders, in their appeal orders against this concept. But still Reserve Bank of India clarified through a frequently asked question number 64 on outbound investment. What they clarified is, can an Indian party, that is an Indian company or an Indian resident, who has set up a subsidiary or a joint venture outside India through its foreign entity, whether it can set up an investment into India? I mean, instead of getting into that jargon, I would like to explain, if suppose there is a company in Singapore, 50% is owned by Indian company or 100% is owned by Indian company, whether that Singapore company can invest in India. They said no, without taking the prior approval of the Reserve Bank of India. Suppose that Singapore company has already made investments in India and which made in India 10 years back, and this year, in the year 2021, some Indian company is going to acquire that Singapore company. Can it acquire? No. There also no. Then what Reserve Bank of India is telling is not with respect to round tripping. It is not the money going there and coming back. Reserve Bank of India is of the very strong view. If there is any cross holding, that is not permitted. That requires prior approval from Reserve Bank of India. So this is very, very important when you are doing any inbound structure where there is already an outbound structure, and if these both are getting intertwined, then we land in FAQ 64. If that is because now I have also seen, I'll give one small example before we get into the outbound investment regulations. One example is a lot of people, a lot of investors will say, especially with respect to startup companies or the other companies, they'll say that you set up a company in Singapore, we will invest in that Singapore, and from Singapore you take it to India. So then the structure has to be designed like this, where the Indian company will open a subsidiary or we will open a company joint venture, and that joint venture company will accept the foreign investment. Such a foreign investment has to come into the Indian company. This structure designing is not permitted. That is the point I want to drive it to you. That requires prior approval from Reserve Bank of India. In some of the cases where we have gone for approval, the conditions imposed by the Reserve Bank of India have made us to conclude that it is better not to have the structure. So that also you please keep it in mind while you are going in for the structuring. I think we'll go for outbound investments. Sir, am I clear now till now?
Yes, sir, you're clear, sir. Audible, sir. We have another
Yes.
10 minutes more, sir.
Sorry?
We have
You
another
have
10 to 11, 15 minutes more, sir. Maximum.
Yes, sir. That is why we will quickly get into outbound investments. Sir. This is the policy. I will just only take 5 minutes time for outbound investments, which is a very, very important topic. These are all the eligible investors, and only prohibition is don't structure anything with real estate business outside India. Banking anyway will not be doing. Overseas entity offering rupee-linked financial products not permitted. Investments in Pakistan not permitted. Investments in non-cooperative countries listed by Financial Action Task Force are not permitted. These things have to be kept in view when you are making any investment outside India. These outbound investments, you have automatic route, permission route, and these are all the how much financial commitment we can make. How much? What are the financial services? What is joint venture? What is wholly owned subsidiary? What is real estate business? These definitions require your attention. I strongly suggest you go through that. These are all the general conditions which are there. I think most of you may be very familiar with these conditions. I will not just run through them again. But only thing which I would like to bring it to your notice is multi-layered structure if you are designing outside India, wherein there is one SPV which is doing only holding the shares of another company. Only one SPV is permitted, multiple SPVs are not permitted. That requires Reserve Bank of India. This is one point that merits your attention, especially when you are making a tax efficient structures. Then two-tier structure of SPV or holding is requires RBI permission. Multi-layered is not permitted, and funding has to be done through. These are all mostly common. Financial services sector, please be very, very careful when you are making investment outside India. Regulation 7 has to be fully complied. What I will do, since we are having only all these things are self-explanatory, only thing I will try to go to the last one: individual setting up companies abroad. Sir, lot of investments are made by individuals in the guise of LRS. By reading the regulation there, that an individual can set up a company outside India under LRS is what some of the people who have made investments are thinking. No, under LRS, only portfolio investments are permitted. If any individual wants to make an investment outside India under LRS as acquiring shares in an unlisted company, then they have to go through ODI filing. They have to go through all the compliances connected with ODI. This is the popular contravention committed across the country. Because if we plainly read the liberalized remittance regulations, it will appear there that an investment can be made by an individual in the listed or unlisted shares. Then we tend to believe that unlisted shares means an individual can also acquire 5%, 10%, 20% equity share of an unlisted company outside India, but such acquisition under LRS mechanism is not permitted. Such individual has to file ODI form, he has to comply with all the ODI regulations, he has to keep filing APR. All these things will come into picture. This is one area which I thought I will bring it to your notice. I have made my presentation a bit more so that you can go through that. And thank you for giving me this opportunity. And if there are any questions, I will take up the next 5 minutes.
I'll share my screen. So we have some 4 to 5 questions. Just take a note. So from here, so 16th onwards. Is my screen visible?
Yes, sir. Yeah, shall we take up the 16th question?
Yes, sir, from 16th onwards.
Yeah, okay. The first question is, does a wholly owned foreign subsidiary fall under the ambit of resident company under FEMA? Yes, sir. A wholly owned foreign company will become a resident company in India, but only if that wholly owned subsidiary in India is investing in another Indian company, then only it will attract all the FEMA regulations with respect to the investment. Otherwise, as far as FEMA, it will be a resident Indian company. Only thing is you have to be careful if it is making another investments into Indian company. If it is making outbound investments, it can comply with outbound regulation. But if it is making investment in any another Indian company, it has to comply with the downstream investment regulations. So then next is 17. NRI wants to invest in a private Indian company and want to become shareholder and director. Can his investment pass through automatic route, or is it required to get approval under FEMA rules?
17, 18, 19, 3 are continuous questions.
Yeah, continue with the above question. Can such NRI acquire 33% shareholding in a private Indian company? Is there a maximum shareholding threshold in FEMA Act? If the Indian private company is in management consulting services and investment in Indian startup, will this require to follow the guidelines issued for inbound investment in financial sector? Continue with the above question. If the above 50% assets and income of the company will be from financial instruments, will this constitute as an investment into a deemed NBFC company? Okay, sir, I think we'll go one by one. Sir, first one is NRI wants to invest in a private Indian company. I am assuming that is into management consultancy services, since you are mentioning management consultancy. That is okay. If it is into financial consultancy, like giving any organizing loans or giving advisory on finance, it falls under financial sector. Be very clear, sir. Otherwise, always in FEMA, you have to look at in which sector it is coming. If that sector is an approved sector, then NRI can invest in a private company and become shareholder. And then the next important question is, you have to understand whether you have to find out whether the NRI wants with the repatriation or without repatriation. If it is without repatriation, income can be repatriated, capital cannot be repatriated. Then it will become non-repatriation investment will be under domestic investment if no permissions are required from RBI and no filing is required from RBI. If it is with repatriation, you have to comply with all FEMA guidelines and you have to file and get your investment approved by RBI. Post investment, you have to file the form and approval has to be given. Now you are telling whether the 33% shareholding is there a maximum shareholding threshold? Yes. This depends upon the sector. For each sector, they have put how much foreign can be there. If it is management consultancy, it can be up to 100%. It is permitted. Okay, if it is a financial services sector and you are arranging loans or giving advisory on corporate finance advisory, then you require prior permission from government, and they may impose a minimum capital requirement, which they are imposing anywhere from 2 million to 20 million US dollars. Be very careful in that. If it is a financial service sector which requires government permission, which is not controlled by any regulator. And continued with the above question, if 50% of assets and 50% of income of the company will be from financial instrument, will it be treated as a deemed NBFC? Yes, it will be treated as a deemed NBFC. You have to get it registered as an NBFC. You have to be, because that is the core fundamental rule of RBI with respect to non-banking finance companies. If it is coming from the financial instrument, it becomes a deemed NBFC company. You need to get it registered. Sir, the next question is, can such NRI investor acquire 33% of shareholding in a private Indian company? Is there maximum shareholding? No, I think again we are going back to the same question, sir. 33% is not the criterion of it. You have to look at in which sector. Software 100% allowed. If it is coming into news media, 26% allowed. Likewise, for every sector, they have put real estate development 100% allowed. You have to look at the 17 sectors specified by the RBI to non-debt instrument regulations in those sectors and which sector it is coming. It is not whether it is a private limited company or LLP. There you have to look at it. Can the next question is, can a non-resident Indian make investment in India in Indian LLP partnership firm? What compliance is required? If it is under non-repatriation, no compliance is required. If it is with repatriation, what is the activity? If the activity is other than manufacturing, then you need to take prior approval from RBI because the FDA linked performance conditions are not complied. These three things what we discussed, you have to verify. What is the threshold for beneficial owner in case of inbound investments are not directly from a country sharing the land border with India? Sir, this is one more given out of a knee-jerk reaction. There is no threshold. They have put any investment coming from a country, even one share coming from a Chinese investor, let us say for example, they are telling investment is allowed but subject to prior approval of the government, so there is no threshold given. Please be very careful. Any investment coming from the neighboring countries requires prior approval from the government. Can resident outside India make investment in a company incorporated in India, which in turn invests in built-up property in India, fully developed? The rental income from the property is earned by the company in India and it's distributed as interest dividend to the overseas. Is this permitted? Will this be under real estate sector? So first, if it comes under real estate sector, there is no problem, but this becomes a financial services sector. If this company is only doing distributing the dividends as a rental income and doing only financial service sector, then I can argue that it is only an investment holding, property holding company. Some other person can argue it is a financial services sector. You are trying to collect money from several investors and make money out of it like a PMS and giving it back. To address this, the central government has made it very clear in the financial service sector. If you are coming out such type of a structure, please come to central government to take the clarification. So I strongly advise in such type of an area, please make an application to central government and get the approval or their confirmation telling that approval is not required, then only get into such type of thing. And please do not make an independent decision with respect to such. It will be treated in SEBI in some cases have clarified such a type of investment vehicle or investment vehicles which require permission from SEBI, and SEBI has not yet given, even though the applications are holding from last 2-3 years. Very careful, very important question, but you need to take central government prior permission. I think I have crossed my time limit by 1 or 2 minutes, and I should thank all of you for giving a patient hearing. And once again, thank you ICAI and SIRC for giving me this opportunity. Thank you very much.
Ma'am, unmute yourself, ma'am. Unmute yourself. Ma'am, no, you are not audible, ma'am. Sorry. No, you are not audible. Sorry. I'll just check with Prasad. So thank you, sir. Thank you for your excellent presentation, sir. And we'll move forward to the next session, sir.
Thank you very much.
Thank you.
Thank you. Thanks a lot.
Thank you, sir. 1 minute, sir. We'll have a small break and we'll start. Karthik sir, are we audible, sir?
Yeah, hello everybody. Am I audible?
Yes, sir, you're audible. 1 minute. We'll resume our session in 5 minutes, or not 2 minutes.
Okay, sir. Okay, sir. Hello.
Please, hello. Sir.
Hello. Okay, sir.
Yes, sir. We'll start our session in next session in 5 minutes, sir.
Thank you. So
Thank you.
I'm checking out. Thank you.
Thank you, sir. Thank you for the time, sir. Thank you. Sorry. 1 minute. Sir, we have Karthik, sir. Hello. Sir, are we audible, sir? Sir, we'll start with the session, sir.
Yes, you can make the presentation. Selva, you have the presentation, na?
Sir, yeah, we have the presentation, sir. We'll go with a small introduction from our secretary, sir. Then we'll.
Panaraj, sir.
Yeah, Panaraj, sir, he'll join the session. Sir, sir, you unmute yourself, sir.
Sir, good afternoon, sir. Warm welcome to you, sir.
Thank you.
I think there was some technical snag in our treasurer's connectivity. So a very warm welcome to you, sir. Thank you for accepting our request to present yourself. I missed the topic which you are.
Foreign tax
withholding
credit.
Taxes, sir. Withholding taxes.
Foreign tax credit. How do we claim? Rule 128 of the income tax rules.
Yes, sir. Yes, sir. So, without taking much of your time, I request you to take over the proceedings.
No, no, sir. I'll take.
What is it? Foreign tax credit analysis? Yes.
So,
Sorry for the technical snag, sir. So please bear with us. Sorry for the technical difficulty. Over to you for the presentation, sir.
Yes, I'll start my screen sharing, sir. No, it's 1 minute. So sorry, sir. 1 minute. Karthik, sir, is my screen visible, sir?
Yeah, visible now. You can go for the full screen. Yeah.
Yes.
So good afternoon to everybody. Being a member of the International Taxation Committee of the ICAI, I'm indeed happy to be addressing all of you with some of my thoughts on the foreign tax credit. Over the next 40 minutes or so, it's already 1:10. Over the next 40 minutes or so, let us try and divide our discussion in two parts. One is, let us go for a quick recap of the modes of credit, how we get credit for taxes which we pay in the source country. And in the second half of our presentation, let us spend time discussing the nitty-gritty actual rules, Rule 128 of the Income Tax Rules 1962, which has come into force. It is already there from April 1, 2017. Next slide, please. Yeah, so this is how we have rolled our presentation. So let's quickly get the basic concepts in parts 1 and 2. Then let's spend little time on what are the methods which are available to eliminate double taxation under the treaty that India has signed with so many countries. And then let's spend time on foreign tax credit rules. And towards the last part of the session, few issues are there what we can we need to have some deliberations, and I will also let you know what are my personal thoughts on those issues, how to overcome them. Next slide, please. So in terms of why we need a foreign tax credit, next slide. Typically, if a same income is suffering taxation in two different places, both in the source state as well as in the resident state, we will need a mechanism how to share, allocate taxing rights. That's exactly what the double taxation treaty is all about. Similarly, there can be the same income which can be taxed in two different people's hands also, economic double taxation. So there are broadly two types. It can either be on the same person, or it can be on the same income is taxed in different people. So juridical double taxation happens when the income is taxed in the hands of the same person in two different jurisdictions. For example, in the next slide, a simple example. Next slide, please. Selva. Yes. So we have the US company here, which is suffering juridical double taxation. This US company is a resident of USA. So it receives some royalty from India, where it has already suffered 10%. So in India source state, 10% is already deducted. And so that 10% is suffering tax here in source state. And also being a resident of USA, the entire royalty is subjected to tax there also on the worldwide income principle. So you see there is a juridical double taxation happening here. Same US company, and the same income is getting taxed both in US as well as in India. Next slide, please. Now juxtapose this with the economic double taxation. A small example again. Now suppose the US company is receiving commission from India. So because it is a US tax resident, it has to offer the entire 100 rupees to tax there in the USA. Now in India, what is happening? When an Indian company is paying the commission, 80 rupees is treated as arm's length and 20 rupees is not. And therefore the 20 rupees has to be taxed here in India. So effectively what is happening, US company is having to pay tax on 20 rupees there in US, being a resident there, as also in India, being a source jurisdiction. So that's different people in Indian companies' hands. Now it is being taxed, this 20 rupees. So you see there are different people suffering taxation on the same amount. So that happens when we are talking about economic double taxation. Next slide, please. Yes, next slide. So where is the authority for foreign tax credit coming into the Act? Well, it is coming in 3 sections, sections 90, sections 91 and 295. Basically, if you see 295, it is the powers given to the powers to make rules to the central government, which it does through the Honorable Central Board of Direct Taxes. So 295(1) says the board may, subject to the control of the central government, by notification in the Gazette of India, make rules for the whole or any part of India for carrying out the purposes of the Act. So in particular, 295 subsection 2, that is the authority for the FTC law, rules and regulations. In particular and without prejudice to the generality of the foregoing prover, and rules may provide for all or any of the following matters. There are quite a lot of matters. Ours is under HA, small subclause HA. The procedure, the rules is being framed for the procedure for granting of relief or deduction, as the case may be, of any income tax paid in any country or specified territory outside India under sections 90 or 90A or 91 as against the income tax payable under this Act. So basically, CBDT has the power which they have utilized under section 295(2) subsection HA, whereby they have laid out the procedure for grant of credit, foreign tax credit, as against the income tax payable under the provisions of the Act. Similarly, you have sections 90. Section 90, most of us are aware, the provisions of the Act or treaty, whichever is favorable, will apply. And India has indeed signed a treaty with so many countries in the course of multinational business and commerce. One question could arise is that if you already have signed a treaty and the treaty already has provisions included therein for elimination of double taxation, Article 23 typically, then why do we need a separate set of rules under the income tax domestic legislation? The answer for that is that at the treaty level, they broadly specify how the taxation, the double taxation relief could be given through a credit method, through an exemption method, underlying tax credit, sparring, etc. We will just see the examples in a bit. But at the same time, they do not specify various, they do not address various issues connected to that. Like what should be, when should be the credit available? What is the mode of conversion of tax amount? How do you convert it? If supposing the income is being offered over multiple years, then how do we allow credit? So on and so forth. What are the documentation which need to be provided to the tax office in support of the claim of foreign tax credit? So on and so forth. So to codify all of them and to also, before this rules were prescribed, FTC rules, they are there in section, in rule 128 of the income tax rules 1962. Before they had been notified, it was more or less like a free for all. Every individual happened to have his or her own interpretation and they were going with that. Similarly, on the taxation the department front, there was no uniformity of application or while granting foreign tax credit. Every tax officer used to come up with some or the new regulation, some or the new requirements, which was creating impediment. And therefore, now you have this codification which aims to address most of the issues which are there while granting FTC. Similarly, section 91 is also there, which says unilateral tax credit. If there is no taxation treaty with a country and there somebody has earned income which is suffering tax there as also in India, then Government of India has enabled section 91, which provides for unilateral tax credit. We will see that in an example also. Basically, it is the lower of what tax is paid there or what tax is suffered under the Act. Next slide, please. So broadly, we have few methods of elimination of double taxation. Either it is the direct or the indirect method. Under the direct method, we have credit or exemptions. So even under the credit, it can be a ordinary credit or full credit. Under the indirect method, under the exemption, you can have either full exemption or exemption with progression. Progression meaning for tax rate purposes, we will include, otherwise we are not taxing it. That's an exemption method. Credit method, whatever tax is paid there, we will get it here. That's full credit. But generally we go for ordinary credit. That also we will see by way of an example. Mostly we are preferring ordinary credits. And as far as indirect method is concerned, it is for certain specific incomes. For example, tax sparing on tax holiday incomes, whether we are eligible or not, how do we calculate? That's tax sparing for you. And underlying tax credit, economic double taxation, when it happens, that is sought to be eliminated by the underlying tax credit. We can brush it up through the means of live examples. Next slide, please. Now here is a credit method we are trying to explore. Now the income earned by a taxpayer in a source state, then it is included here in India in the resident state. And generally, friends, one point here, the foreign tax credit rules are applicable to a resident. And the reason for that is that it is only the resident who is offering the global income to tax here in India. A foreigner or a non-resident offers only limited income, what is having nexus with territoriality of India, only that much only he is offering to tax here. Therefore, there is no need for separate set of codes for enabling credit for a non-resident. Therefore, FTC rules apply for a resident. So under credit method, the resident state grants credit for whatever taxes have been paid in the source state. Okay, this is, like I said, there in most of the treaties that India has signed, and that too, of the two variants that you see on the right side of your screen, ordinary and full credit, we are generally using the ordinary credit method. Full credit meaning whatever tax is paid in the source state, entire amount is, if it is included in India and offered to tax here, then the entire amount is given credit to. For example, Namibia Treaty. Let's see that in the next slide. Selva, next slide, and we come back to this slide. Yeah. There is a live example here. If you see the India-Namibia Treaty, Article 23, I told you, that talks about, that contains the provisions for elimination of double taxation. So it says in India, double taxation shall be eliminated as follows. Where a resident of India, naturally, the FTC rules, like I said, are being applied for a resident. If an Indian resident is deriving income or capital gain from Namibia, which is also being taxed in Namibia, then India shall allow as a deduction from the tax on the income of that resident an amount equal to tax on income what has been paid in Namibia, whether directly or by deduction, either by TDS, which is deduction, or through payment of tax, which is directly one of the modes. So this is one live example how in India Namibia Treaty full tax credit has been given. Selva, earlier slide, please. Similarly, we also have ordinary tax credits. Ordinary tax is that credit for tax which is paid in source state. It is allowed only to the extent of incremental tax liability owing to its income here, meaning more like a slab rate. And if the tax paid in the source state is higher, then that we will ignore it, meaning India will not be out of pocket on account of any credit that we are going to give here. Let me demonstrate by an example. Selva, 2 slides ahead, please. 13. Next one. There you are. So in a single slide, we are trying to demonstrate all the 3 categories which are possible. So let me say that there is an income which is doubly taxed, which is 100, the top line. And the withholding in the source state is 10%, 6th line. So naturally, on one hand, the TDS amount which has happened in the foreign jurisdiction is 10. So that is the row number 7, what you can see after 10%, no doubt about it. On the other hand, on a net basis, the income of 20, third line, 20 plus 30, that's 50. Now we have net taxable income 50, which the resident state will be taxing at the rate of 30%. Naturally, it is 15 rupees. So if there is no FTC, foreign tax credit available, we will need to pay 15 rupees here in India. So the total tax liability for the resident then becomes 10 rupees of TDS, what happened in the foreign source state, plus 15 rupees, what he has to pay here in India. Yeah, 15 is 30% of 50 net taxable income. So 25 rupees he has to pay tax here in India. That's on if there is no FTC available. On the other hand, if full tax credit is available, then the 10 rupees anyway, it is a withholding tax which has been paid to source state. That is there. But that amount I can offset against the 15 rupees what I have to pay to the Indian tax authorities by way of my being a resident. So 15 minus 10, only 5 rupees I have to pay here in India, which means 5 plus 10, what I have already paid in Namibia. So that 15 rupees, total tax liability for me is 15. On the other hand, if I go for an ordinary credit, meaning Indian government will not be out of pocket owing to allowing credit, in that case, again, the 10 rupees what I had to pay withholding tax in Namibia, that 10 rupees I have to pay anyway. Tax in India in this case is 15 rupees because it is 30% of 20. However, what is happening is that Indian government now says we will not offer you the full credit of that 10 rupees. We will give you to the extent of 30% on 20. That's 6 rupees only. We will give you only 6 rupees credit. And so 15 minus 6, that is 9 rupees. I have to pay tax here in India, ordinary tax credit. So 9 plus 10, 19 rupees comes to be the overall tax liability under the ordinary credit method. Next slide, please. On the other hand, I go for an exemption, full exemption. Very rarely we have a treaty like that. A full exemption meaning if I have paid some tax as a resident of India, I have paid some tax on income in, let's say, Brazil, and then India will exempt that entire income. That's the import of full exemption. Generally, it is not common. We have, but India-Brazil treaty where we have seen this in operation. Selva, next slide, please. I can show you the live wordings. Again, Article 23, method for elimination of the double taxation. That they say that where a company which is a resident of India derives dividends which may be taxed in Brazil, then the first mentioned state, that is India, shall exempt such dividends from tax. Exemption method, full exemption. Article 10, paragraph 5 or Article 10, paragraph 2, they're all talking about dividends. To the extent of 15%, it can be taxed, something like that. That's what the Article 10 will talk about. One slide back, please. Similarly, so this is the example of a full exemption. If the same income is already taxed in source state, that entire income we can exempt here in India. Government of India is exempting it. That comes through Article 23 of India-Brazil Treaty. For example, we saw the full tax exemption method. Similarly, with progression, if you want to see, generally what happens in this case, almost it is similar. Just that whatever income I have offered to tax in Brazil or let's say for source state, that I will include it in India for the purpose of rate difference, and then I will give the credit. It will still be exempted, However, it will be the double taxed income will be included for rate purposes. Again, I will show you by an example. Slide 16, please. Yeah, this again is India-Austria treaty. One example for exemption with progression method. What they say is that where, like I said, where in income derived by a resident in India or of India is exempt from tax in India, India may nevertheless, in calculating the amount of tax on the remaining income of such resident, take into account the exempted income, meaning we will include it for rate purposes. And the example I am showing you in the next slide, 17, please. Yes. Now, again, three scenarios. The total income which is being earned by the taxpayer is 220, let us say, and income earned from the source state is already 40. Then, if I don't have any FTC, what I'm supposed to do? What is my overall tax liability? Tax in resident state, assuming it is 20%, sorry, tax in source state, assuming it is 20% tax bracket, then 20% of 40 rupees, that's 8 rupees I have to pay everywhere. So source state, there is no problem. As you can see, the fourth row, 888, it is common. The difference only happens in the tax in the resident state, because the resident state only is giving credit through the FTC mode. So in a situation where I don't get any FTC, the tax will be on 220 rupees. Now the slab is tax rate for income above 200 is 35. So directly 35%. 220k upar 35%. That's 77 rupees. So 77 plus 8, what I have paid in source state, 85 rupees is my overall tax cost. However, if I'm getting full exemption, what happens? On 220 rupees, that entire 40 rupees is already taxed there in the source state. So I will give full exemption. I will eliminate it from tax here in India. I will not tax that. In which case on 180 rupees, now that I have fallen below the rate differential thresholds. So below 200, it is 30%. So 180k upar 30%, that's 54 rupees. Plus that 8 rupees what I have already paid in the source state, that anyway is my tax cost. 54 plus 8, 62. So therefore, it is the best method what is possible from a taxpayer's point of view. However, broadly we are going in for exemption with progression, meaning we will take into account for rate purposes. And how does that live example happen? So on 220, again, I am not going to tax that what income has been earned in the source state. 40 rupees, I am not going to tax. So 180 only will be taxed. However, for slab purposes, I will have to include it in reckoning. I will have to take it into my reckoning, which means now for income above 200 rupees, slab rate is 35%. So it won't be 30%. 35% of 180, 63 rupees. So 63 plus whatever I have paid there through TDS in or in source state, 8 rupees. So total tax liability comes to 71 rupees. That is the example as far as exemption method is concerned. We will spend more time on the form 67 and the rule 128. That is actually the way how we will be able to enforce our claim credit. So I will quickly go through the other examples, brush up more like an example for the balance 2, which is underlying tax credit. So UTC, underlying tax credit happens. This is mostly to eliminate. Next slide, please, Selva. This is mostly to eliminate economic double taxation. Economic double taxation, just to recap, different people suffering taxation in different jurisdictions on almost the same set of amount. Yeah. So there is a possibility a state is taxing a company on its profits, and in another case, when the shareholder is receiving the dividend, again dividend is also taxed. So the concept of UTC is that at both these stages you are suffering taxation. In the we want mutual trade and commerce to flourish. Therefore, the resident state, what they do is that they will give credit for both the taxes. Taxes in the hand of the company, taxes in the hand of the shareholder also. So this is a very largest. It's more like a benevolence, which is handed out to by countries, especially where they typically want inflow of capital. It is mainly to promote inflow of capital. So let me just show you by way of an example. That will be faster. 19. Next slide, please. So in the source state, again in source state, not much action happens. All these are for resident state only, and the resident state ends up giving out its tax, most of its tax rights. That's broadly the concept here. So in the tax, in the source state, what has happened? The company has earned 150. The corporate income tax there is 30%, so 45 rupees. There is a amount A. We have to pay 45 rupees there. And dividend is paid 80 rupees to the shareholder. 5% withholding tax rate is there. So we have to now pay 4 rupees. So 45 plus 4, 49. This is the total tax in the source state. When you come to resident state and you implement FTC rules, what happens is that entire 49 rupees you will give credit here. That is the concept of UTC, underlying tax credit. So here in this example, that 80 rupees is received by the shareholder here as a dividend, and the company's tax is 45 rupees there, what is being paid. So 80 plus 45, and so the grossed up part is 125. Tax on that is 50 rupees. So whether we have to pay 50 rupees, answer is no. 50 minus the credit for underlying profits, we already paid 45 rupees there, and also credit for dividend 4 rupees, that also we have already paid there. So only balance 1 rupee we have to pay here. 50 minus 49. Next slide, please. Tax sparing. Tax sparing broadly is again another measure where the resident state says, okay, I will spare the taxes, whatever is being exempted in the source state. Okay. Just see the example in front. So what happens is that in the resident state, there is an interest income from government bonds. In the 200 rupees that we have earned here, the tax rate is 30%. If there was no tax sparing, I have to pay 60 rupees tax, 30% of 200. However, the concept of tax sparing, that will lower the tax liability. How? In the source state, we have received this 200, and this 200 otherwise would have been exempt under the act, but under the treaty it is 10%. So what we say is that, look, it would have suffered taxation of 10%. Therefore, to that extent, what would have been taxed, we will give you the credit for that. That's 20 rupees. That we will 10% of 200. That we will use as a tax sparing credit, and the balance of 40 only is then paid. Again, a measure to promoted to where we wanted to promote inflow of capital. Last example before we turn to the rule 128. Next slide, please. Unilateral tax credit. Sometimes it so happens that we are better off even without the FTC rules. Why? Because unilateral tax credit is far more simpler, and perhaps in such a situation it is beneficial to the taxpayer. What happens is that this is section 91 in play. If India has, it of course it applies to a resident of India, income should have suffered taxation outside India, and we don't have a treaty with that foreign country, in which case whatever tax is paid there, that we will give credit here, we will take into account here. However, the concept is that Indian government says whichever is maximum. So we will not be out of pocket. We will give you credit, but only to the extent of lower of what tax you paid there or what tax you are going to pay here. Lower of that, we will give you the credit. So see the example here. 100 rupees is earned in the foreign country. In India, it is 30%. So 30 rupees I have to pay anyway here. But already this gentleman has paid 20 rupees in the foreign country. So what government of India says on that 100, look, 20 rupees you already paid tax there. I will give you credit for 20 and balance 10 only you pay to me. 30 minus 20. So this is the unilateral tax credit. Government of India on its own is giving foreign tax credit. That's under section 91 of the Act. One more slide before we go for rule 128. So with the advent of MLI, we have so the MLI broadly it was giving an option to convert wherever earlier you were going for exemption method. Please, there is an option you can convert into for credit method. So India has actually taken that option. We have chosen to apply out of the 3 options what were given. We wanted to do credit method only in all cases where exemption method we have already given. It's a way of setting that thing right. Wherever we gave exemption, we now will go for credit method. Something like that is what Indian government says. Yeah. Chaliye, next slide. Let's now spend some time on the very important rule. So this is exactly how we will be able to claim credit. Rule, it is contained in rule 128 of the income tax rules 1962. It is effective from April 1, 2017. So basically it has about 10 parts. Quickly, I'm going to talk about that from this slide only. So what the rule says is that an assessee being a resident, he shall be allowed credit for the amount of any foreign tax paid by him. Please note, paid by him in a foreign country by way of deduction or otherwise. I will explain deduction or otherwise. In the year in which income corresponding to such tax has been offered to tax or assessed to tax in India in the manner and to the extent specified in this rule. Rule 128 subsection 1. So it is basically applying to a resident only. Why only resident? We saw earlier that it is the resident who is suffering worldwide income here in India. Foreigners are not, non-residents are not offering their global income to tax here, and therefore if anybody has to be remedied, it is the Indian resident, because he is going to tax the global income, including the foreign source country taxed income, as well as the residents on residence basis also. So it has to be applicable to a resident. What is being allowed? It is the credit is being allowed for the amount of any foreign tax paid by him. Tax has to be paid, because in later point you will see, especially in the last rule 8, what is the documentation you have to give? You have to show proof that that 8 whatever tax you are claiming credit, you have already paid to the foreign government, and naturally so. If the tax is not paid, then how you can claim credit? Government of India does not want to be out of pocket on that. If you understand the thought process behind Government of India's way how they have approached this FTC rules, it will help in in interpreting in a particular fashion, and B, avoid us to take reckless risks or very aggressive interpretation, and C, will minimize litigation. The Government of India's thought process behind Rule 128 seems to be that we don't want to be out of pocket. I will not suffer any loss, because ultimately, understand please, in a foreign tax credit, though the taxpayer is getting, Indian resident taxpayer is getting benefit of FTC, Government of India does not get any cash by way of recompense or by way of any reimbursement from the foreign jurisdiction. It is a benevolent act. So this tax, what is being paid, foreign tax paid by him in a foreign country, that we will give you by deduction or otherwise. Why deduction or otherwise? By deduction meaning, in many cases in treaty we are seeing there is a tax deduction at source. So deduction or otherwise. In some cases we may even end up paying, because all jurisdictions are different. In some cases we end up we have to pay the tax. In some countries, whatever is deducted as a TDS, that's good enough. That's the finality. Matter is reached finality. We don't have to file tax return and so on and so forth. Whatever the deductor has deducted, that's good enough. Matter is over there. So by deduction or otherwise, when you will get the credit? In the year in which the income corresponding to such tax you are offering to tax here in India. Very important. If it goes through multiple years, for example, again calendar differences could come. In India, we are following April 1 to March 31 as our fiscal year, previous year, relevant to assessment year. In UK, for example, they start from 4th or 5th of April and accordingly end little ahead of us. US, for example, follows the calendar year, January to December, so on and so forth. So you can see there are some disparities in the period itself. And so what happens if there is an overlap? To remedy that, proviso to Rule 128(1) has come in, where they say, in a case where income on foreign tax, on which foreign tax has been paid, is offered to tax by Indian resident in more than 1 year, credit shall be allowed across those years. So there is a provision to claim FTC over multiple years for a same income. Now it depends on when the income is being offered to tax in the foreign country and when the tax is paid. Ultimately, remember friends, the importance is that tax should already have been prepaid. If you are going to pay, you will not get it. There is no FTC available for I will pay tax in future. No, you have to already pay that and show the proof under Rule 128(8). We will see that in a minute. So 128(2), it talks about definition of foreign tax. Yes. What is the what taxes are covered? So Rule 128(2) has two parts, A and B. A is where India has had double taxation avoidance agreement. Please look into that for the guidance. Know what is a foreign tax. Article 2 of all our tax treaties, typically they will have specific guidance on what is covered. For example, in Namibia, let us say, or in US, they would, in India they will say tax means income tax, surcharge and cess. Similarly, in US they may say federal tax, that tax which is there in the specified in the Internal Revenue Service Code and so on and so forth. So whatever is specified under the treaty, only that tax you can claim credit here under Rule 128 and not anything else. In our treaties, we have seen there are some Indian tax treaties which also have branch tax. So tax on turnover. So by whatever name called, so long as it is there as a defined in the tax treaty, then you can, because when we actually sit to file tax return and our client is coming and giving us the tax return he has filed in the foreign country, and he says, sir, will you please compute that foreign tax credit, we should be able to know on what FTC is eligible under 128 and on what not. Typically what happens, friends, is that Rule 128(2) has defined foreign tax. There could also be a situation where some taxes are not covered under the treaty that India has. So the question then could arise whether we can claim credit for that also here or not. Strictly speaking, Rule 128(2)(a) does not allow, because that is restricting you to what is a definition of tax, foreign tax covered under the treaty. there we may have recourse to section 91, where unilaterally India is giving credit, provided and again there is a honorable Karnataka High Court judgment, I think it is Wipro, that also we can make use here, but it is slightly litigative, because the definition of foreign tax as is provided under the treaty, meaning generally tax officer will want to interpret strictly in accordance with that. Anything outside that, I will not give you credit. That's what he may say. Rule 128.2 has the second part. A is for where India has treaty, then look into treaty for guidance of what is foreign tax. In respect of any other country or specified territory outside India, that is section 91 case, then tax payable under the law in force in that country, as is referred to in explanation to section 91. Broadly, if India does not have a treaty with any country, then whatever tax has been paid there in that source state, that amount we can claim as foreign tax credit here in India. That's what is the definition provided under Rule 128.2 subpart B. Okay, now the next question is Rule 128.3. Credit is against what? So credit is generally available against amount of tax, surcharge and cess only. Whatever we are going to compute in India against the normal tax, then the surcharge on it, and then the cess on it, all put together. Against that, I will give you credit. Not on interest, not on penalty, not on any fees or anything that you will pay. Under fee under 234E and all, I'm not going to give you all that. The rule says that is credit is available. FTC credit under 128 is available only against whatever income tax, surcharge and cess that you are going to pay here in India. 128.4. Yes, important. They say that if the foreign tax, whatever you are paying in the foreign state, if you are disputing that there, I'm not going to give you credit here. Please first let the matter be settled. Let there be a finality as to the tax amount. Then we will give you credit. What happens is that, and what is the logic for that? The logic could be that so long as the amount itself is not crystallized, it may vary also in appeal tomorrow. So therefore, the Indian tax authority is very cautious. Like I said, there is no incoming of tax revenue for the Indian tax authority owing to allowing FTC. It's a benevolent gesture. It's a gesture aimed to mitigate hardship for Indian tax residents. So they are saying that, look, we will give you credit under these rules in this manner. However, if it is disputed, let that dispute be first settled. Show us the proof within 6 months that this matter is resolved and this is the final tax liability which has crystallized. Show us the proof that you have paid it and we will give you credit. That is what they have provided in Rule 128.4, including the proviso. In proviso, they say that credit for disputed tax shall be allowed for the year in which income is offered to tax. If assessee has within 6 months from the end of the month in which dispute is finally settled, you please furnish the evidence of settlement of the dispute and also an evidence to the effect that the liability for payment of such tax you have already paid there, and also give an undertaking that you will not or you have not already claimed refund of that amount, so that you end up refunding there, and also you are claiming double non-taxation. Then here you're not, you're claiming FTC also here. So broadly, that's what they are seeking to cover in 128.4 rule. They say if it is disputed, we will not give you credit. We will give you credit if it is final, certain, and you have actually paid there and given us the proof, and also a declaration that you will not be claiming a refund of that in future there. That is the premise, no? The premise is that the same amount is suffering taxation in two places, therefore you are claiming relief. So if you have already got refund there, why are you coming and claiming here? You cannot do it two times, no? Very important. Rule 128.5. The how you will, to that extent, how you will compute FTC. FTC will be calculated. It is supposed to be the aggregate. This is a slight let down actually. It creates a lot of practical problems when we actually sit down to do the tax credit. Why? Because it says the credit for of foreign tax, what you are going to pay there, shall be the aggregate of the amounts of credit computed separately for each source of income arising from a particular country. Okay, then there is a comparison, whichever is lower. I will come to it in a minute, but this part itself is the hardship. What they are saying, look, I'm giving you credit. What you are going to pay there, please come here, I'm going to give you credit. However, you please compute it separately for each source of income, not head of income, friends, source of income. It is another matter. If you see the form 67, there under source, they have listed all heads of income: salary, house property, capital gain, business, and other sources. Actually, that seems to be their thought process. But then they have used the word source. Source is different from head. So they say, what you are paying tax there, compute the tax for each source of income. Dividend from one particular company in US, that is a source. Dividend from second company in US, that is second source. So for each line item, I have to do this examination, and whatever is lower, I will then claim credit of that. So if I have as many sources or line items of revenue, that many line items I have to fill in the form 67. And form 67, if you will see, it's a 13 column form where almost all aspects of this discussion what we are having, they are taken cognizance. Yeah. So the credit for foreign tax shall be the aggregate of amounts of credit computed separately for each source of income arising from a particular country. And how you will get that, how you will give the effect? The credit shall be lower of tax payable under the Act, tax payable under the Act on such income, and foreign tax paid on such income. Here it is payable if it is under the Act, and in foreign country it has to be paid. Then whatever is lower, that much only I will allow you. No difficulty as far as foreign tax paid is concerned. I told you earlier, I will pay in future and all, doesn't cut any ice with the Indian taxman. You please pay the tax in the foreign country, show us the proof that has suffered taxation, show us here, and then we will give you credit. So the second part offers no difficulty, foreign tax paid, that is B. As far as A is concerned, credit shall be lower of the tax payable under the Act. Payable under the Act. That amount, what you are going to say is already suffered taxation there, that should equally be payable at that point of time. Now in a year, dividend is taxable there, but in a year it is not taxable here, forget it, you won't get it. So therefore, what is taxable there also has to be taxable under the Act. There is also a proviso for foreign tax credit, what foreign tax paid exceeds the amount of tax payable in accordance with the DTAA, Double Taxation Avoidance Agreement, excess is ignored. Again, interesting. Please understand the logic. If the logic is understood, we will minimize litigation. At the same time, it will also put paid to any kind of very aggressive credit, and at a later point, we will be saddled with penalties. This proviso to fifth rule 128.5, first part, the proviso says where foreign tax paid, whatever is being paid abroad, that exceeds what is taxable under the treaty also, forget it, that excess I am not going to give you. Indian tax authority will not give credit. Meaning what? Friends, oftentimes what we do in our reverse situation, we examine a particular payment, it has come to us for form 15 CACB, we say, oh, it is likely to be taxed. It may be not taxable under the treaty, there is make available clause and whatnot. So it is prima facie not taxable, but I am not taking any risk. I am defending my payer, he is my client. So I end up authorizing them to deduct TDS. I advise them to deduct TDS, and they end up deducting TDS on the higher side. That is exactly why now foreign countries, most of the recipients say, we have nothing to do with your Indian tax laws and all, give us net of tax. We need 100, that's it. Any tax and all, you bear it. So what this proviso says, if under the treaty that foreign tax credit is not due to be, foreign income is not supposed to be taxed at all, and if any tax you have paid in the foreign country, that we will not give you credit here. We will give you credit here in India only in respect of genuine income which has suffered taxation in foreign country on which you have paid tax B, and that same foreign sourced income is also supposed to be taxed here in India either under the act or under the treaty. If it is not and you have paid excess, thank you very much. It is your cost. I am not going to give you credit. That's what they are saying in 128.5.1 proviso. The 128.5.1.5.2 that prescribes how you will compute or translate the foreign tax. Friends, for conversion of income, we have rule 115 or something like that. Either we will take average rate, or you will take the date of transaction, or you will go for 1 month prior and last date, whatever TT buying rate was there. Insofar as tax is concerned, and that's one good reason why we have this rule 128, so that now at least some clarity they have brought it. Otherwise, everybody will do according to their whims and fancies. Rule 128.5.2, it says what? Credit shall be determined by conversion of the currency of payment of foreign tax, because in foreign country we would have paid in foreign currency. So credit shall be determined by conversion of the currency of payment of foreign tax at the TT buying rate on the last day of the month immediately preceding the month in which such tax has been paid or deducted. Let's suppose 15th of August, there is a tax deduction which is happening in a foreign country. Then July 31st, whatever was the rate, TT buying rate for that currency vis-a-vis Indian rupee, that is what we will take, and we will convert that tax amount into INR. That is what they have given guidance here. Yes, I will take 5 more minutes. As far as rules 6 and 7 are concerned, slightly technical. What they are saying is that they will give FTC against MAT or AMT also. So in India, if we are going to pay tax on the MAT basis, I will give you credit, no problem. However, there is also something called MAT credit. If suppose in later part I am going to pay under normal, then the delta between normal and whatever MAT I paid earlier, that I am able to carry forward for some number of years and then set off in the next year. That is the credit concept. That delta, any amount in exceeding in that, I will not allow. In other words, Indian Tax Authority says, look, otherwise whatever MAT credit you are eligible, that much, to that extent only foreign tax credit I will give you. Anything in excess of that, I am not going to give you. Again, the thought process itself seems to be, I am already giving you a lot. I don't want to be out of pocket on that. I am not going to get any recompense, or I am not going to be reimbursed by the foreign jurisdiction. So please claim only to the extent what I would have otherwise allowed you. That's the maximum I can give you. So that's rules 128, 6 and 7 for you. FTC will be available against MAT to the extent of difference between FTC allowable under MAT and normal provisions. That excess I am going to ignore you. That brings me to the last aspect, 128.8. Very important. What are the documents? How you will claim it? So they say, earlier again there was no clarity. Thankfully now, because of this rule 128, there is some clarity. They say, look, please file form 67. Form 67 is to be done online and self-certified by the assessee taxpayer before filing his tax return and it is a statement of income from the country, meaning what all incomes I have got to tax. Yeah. So 1 second. I think I have it. Yeah, so it's like I said, it's a 13.2 pager actually. It's a 13 column table that's there in the form 67 for you. So serial number, name of the country, source of income. Source of income, they have listed out all these: long-term capital gain, short-term capital gain, interest income, dividend, royalty not forming part of business, FTS, others, specify. Then they say income from outside India. Then they are calculating the tax paid outside India, amount and rate. And as far as tax payable on such income under the normal provisions of the Act, also under MAT, they are wanting to check that also. And then they say what is the credit available claimed under 90, section 90 or section 90A, which is the article number, what is the rate, what is the amount, all that they want you to compute. Now, like I said, it has to be done for source wise and then aggregated. Credit claimed under 91 and the total foreign tax credit claimed. And then in the next page, they have part B. It's two parts actually. Part A is calculation and part B is whether any refund of foreign tax you have claimed in the prior accounting year. I'll come to it. I think that is the last item they have. Yeah, so one is you give me form 67 and also you give me a certificate either from the foreign tax authority certifying what is the nature of income and what is the amount of tax. I need these two information for me to allow you the credit. That's what Indian tax officer says. Or if you are not able to get it from the tax authority, at least from the deductor you get me what is the nature of income. For me to be able to give you credit, I need to know what is the nature of income and whether you have actually paid any tax there and how much. If you are not able to get me even the deductor, at least you sign this certificate or the statement and give me what is the nature, etc., etc. Provided if I'm doing it on a self-certification basis, then I have to give evidence of the tax amount actually having been paid there and proof that it has actually been deducted. Ultimately, nothing happens on reliance basis. Insofar as 128.9 is concerned, we already covered. Statement in form number 67 and the certificate, whatever we just spoke, either from the tax authority or self-certified or by the deductor, that has to be furnished before filing the tax return. That's 9, sub rule 9. Sub rule 10 says form 67 is the same form you have to utilize even in a very peculiar situation. What situation it is? Where there is a carry backward of loss for the current year. This is there in foreign countries. Generally, India, we don't give carry backward and all that. So if in foreign country, you already paid tax in the of some income 2 years back, but 2 years later, you ended up having loss because of COVID and other situations. Now you want to activate a provision which they allow in foreign countries in certain jurisdictions where you can carry backwards whatever that loss is there and set off against what income you already have paid. So in which case in that year you will get refund. So for that refund, but that foreign tax credit you already claimed here. So to nullify or reverse that effect, you can make use of the same form 67. We will allow you to retrace or retract your FTC. That same form 67 you can use. That's the provision allowed in 128 rule sub rule 10. Form number 67 shall also be furnished in a case where a carry backward of loss of the current year results in refund of foreign tax for which credit has already been claimed in any earlier previous year or years. Okay. One interesting decision recently it has come. I think this is Bangalore ITAT, Honorable Bangalore ITAT. They say taxpayer is entitled to credit even if there is a delay in filing form 67. I think that was in one individual lady's case, and it was a case where India-Australia treaty was being interpreted. They said that the credit rules emanate from section 90, and in section 90, if there is a bilateral double taxation treaty, there is no requirement there that all the procedural requirements you have to fulfill. So long as there is no such bar for militating against the credit of claim of credit of FTC, then the credit should anyway be allowed, even despite the fact that Form 67 was submitted late. So something like that is also available now. And so that's broadly what it is, friends. A very benevolent provision, which is little cumbersome for us, but at the end of the day, we will definitely get value addition. We will be able to deliver value addition to our clients. Just that we will have to go through Rule 128 and certain practical issues which are available, that also we may have to tackle. I have just another 1 or 2 more minutes. Next slide, please, Satya. Some few issues quickly I will address. Whether credit for federal taxes is allowed under section 90 or section 91. Well, as far as federal taxes, no issues. Generally, India's definition we saw, right? It has to be there in the definition clause. What is foreign tax? It has to be defined in the treaty. So in most of the treaties, federal tax is available, already defined. Trouble arises only in countries like USA, where they are having county taxes, state taxes, federal tax, etc. There, I think I touched upon it that time itself. State tax also we should be able to. There are a lot of judgments which we are having, man-made law, where state tax is available. The logic being that it is under section 91, unilateral tax credit, a situation where India does not have a tax treaty. Personally, I find it very difficult to digest that. Why? Because can we say that, see, what is 90 and 91? The difference is only in 90 there is a double taxation avoidance agreement between India and the country, not county or state. In section 91, they are saying relief I will give you even if there is no DTA with that country. So can we say Michigan, Detroit, they are all states of United States of America. Whether we can say that there is no DTA with Michigan. We actually have had DTA with the United States of America only. So I have my reservations, but till such time there are no contrary rulings coming from any of the honorable tax courts in India, we should be able to claim credit of state as well as federal taxes, no problem. Yeah, even otherwise, Rule 128 is not saying you cannot do so if it is a state tax. So on that basis also benevolently I think we can take credit. Whether the payment of tax in a foreign country is must be in the same previous year, answer is actually it is not. It is advisable that it is in the same year, but often, like I said, there are calendar years, there are differences in tax years amongst various jurisdictions. So there can be a situation that way. But as far as the rule is concerned, rule says the foreign tax has to be prepaid. Pay it before, show us the proofs, get the credit. So that is the impact. Insofar as credit in case where a company incorporated in US becomes a resident in India by virtue of POEM being in India. Remember, friends, Rule 128 applies to a resident, and the moment this US company is a resident, in my view, it will not be able to lay hands on FTC. What we can do in this case is to mitigate. In US, you can make an attempt, not in India. Tax credit, whether available even on in portion of exempt Indian income. Again, a tricky situation. There is this Honorable Karnataka High Court judgment, I think, in Wipro, where they said on 10A also, 10A income, I don't have to pay any tax here in India, and that amount of exports, on that I suffered some payment of tax in the foreign countries. Can I claim credit here? Again, on the basis of section 91, Honorable Karnataka High Court has allowed credit. But strictly speaking, if there is no tax, that amount is not suffering tax in two places, principally it is wrong. It should not be claimed. You cannot claim, it is not qualifying for FTC under 128. Reason is very simple. Indian government does not want to be out of pocket, and this amount is only taxed in the foreign source, not in the resident country. Na? Therefore, it should not be available. But like I said, that is discussion is for another day. But so long as there is a benevolent honorable court ruling here in India which supports this position, you can claim credit, even available on the exempt Indian income. So with that, I think I have come to the fag end in the allotted 1 hour. Thank you, friends, that I have exceeded my by 10 more minutes, I think. So thank you all. Thank you for a patient listening. Thank you to my committee, of which I am a very proud part of, Committee of on International Taxation. Thanks also to the SIRC for giving me this opportunity. Thanks, and wish you all a very good afternoon.
Thank you, CA Karthik, very much. First, for sparing your time and sharing your knowledge with us, and two, for stepping into Mr. Arpit Jain's session as he was unable to join us. I'm sure you did that at a very short notice, and you've done a fabulous job in covering the topic which he was supposed to take up. So thanks a lot for that, sir. But since we have exceeded the time, I think it's almost 15 minutes past our time, we will not take up the questions right now. What we will do is we share the questions with you through mail, and maybe you could send us the answers and we can share it among the participants if you have no objections to that.
Please proceed.
Yeah. Okay. So thank you very much, sir. Friends, we've come to the end of today's session. Thanks a lot to all the 3 learned speakers who have actually come and share their knowledge with us in this dynamic topic of international taxation, where which hits us at many points in time during our day-to-day practice. Thank you very much, Karthik, sir. So we will see you all again tomorrow. Thank you very much, sir. Thank you.
Thank you.